Independence Day, we're looking for jobless claims in America to climb to 235 from 233 recently. So that's in our survey. Our survey for Friday, incidentally, payrolls Friday, 200K is the headline estimate now in our survey, Lisa. That is down from 272 in a previous month, but 200K is still pretty punchy, isn't it, on headline payrolls?
It depends, right? It depends where the jobless rate comes in, and it depends what the neutral level of jobs created has to be to create enough jobs for this economy. I would say the unemployment rate, which is expected to stay at 4%, is going to be key. I also think that the JOLTS number is going to be really particularly important since it's a forward look at the potential openings at a lot of different companies.
On the edge of uncomfortable, the unemployment rate, Citi's Andrew Honhorst. That jobs data drops Friday morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Bloomberg has learned that the Democratic National Committee is considering formally nominating President Biden as early as mid-July. Sources say a potential date for the nomination is July 21st. That's when the Democratic Convention's Credentials Committee meets virtually. The DNC says the plan is not a response to the fallout from Biden's poor debate performance. More home buyers in Manhattan are taking the plunge instead of waiting for rates to come down. According to firms Miller Samuel and Douglas Elliman Real Estate, closings for co-ops and condos spiked 12.2% for the second quarter this year compared to last year. The median price of $1.18 million is slightly down, but that's still hovering near records. Deals closed with a mortgage were also up 15%, while deals closed with cash were up just 10.6%. And Portugal has secured a spot in the quarterfinals of the Euros after a dramatic win over Slovenia. Cristiano Ronaldo's extra time penalty shot was saved, while Slovenia missed a clear one-on-one. Both of those chances, had they scored, would have likely proved decisive. The match finished 0-0 and went to penalties, where Portugal's goalkeeper saved 3 consecutive shots to secure the victory. Portugal will meet France in the next round after they beat Belgium 1-0. And that's your Bloomberg Brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes. What a fantastic European Championships this has been. Just like underdog after underdog, taking it as close as you could possibly take it.
And the games have been incredible, I have to say. Even some of the winners that have actually been predicted, winning by a hair and really not exactly getting the victory that a lot of people expected.
See Cristiano crying yesterday?
Yes, I did.
Brutal.
I know, but that's the thing.
People took satisfaction in that. You know, I couldn't. I found that heartbreaking.
Yeah, no, I get that. It's sort of, it's embarrassing.
It made up for it in the penalty shootout anyway. Embarrassing.
Well, it's like, you know, you need to sort of be there for your team and kind of keep it together.
Of course, I agree with that.
Have composure, totally. And you don't want to be completely losing it.
It's all about him.
I get it.
I get it too. Up next on the program, warning signs emerging.
Usually, as they describe, unemployment goes up like a rocket and comes down like a feather. And so that's on everyone's mind. The job market is still quite strong. It's just been some warning signs.
We'll talk about those warning signs next on the program. Live from New York City, this is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Live from New York, welcome to the program. Equities right now on the S&P, your scores look like this. We're negative by a third of 1% on the S&P, pulling back from yesterday's gains. In the bond market, yields lower too after pushing higher Friday and Monday, but down a single basis point, 444.74. More economic data coming up a little bit later. In the FX market, dollar strength against the bulk of G10, including the Japanese yen and the euro. Euro dollar 107.16. Under surveillance this morning, warning signs emerging.
In the Fed's dual mandate, we've been doing great on the employment side, and we have done far less great on the inflation side. But now inflation is coming down, so we got to think about both sides. Usually, as they describe, unemployment goes up like a rocket and comes down like a feather. And so that's on everyone's mind, that there are some warning signs in the job market. The job market is still quite strong. It's just been some warning signs.
Here's the latest. Fed Chair Jay Powell speaking at 9:30 ahead of a busy week of labour market data. Jolts coming at 10 a.m. Eastern time this morning. Jobless claims tomorrow, and the main event, the payrolls report, coming on Friday. Claudia Sum of New Century Advisors writing this: a good labour market is not a reason to wait. The reason to cut is that inflation is down considerably. A good labour market is what's at risk if the Fed doesn't. Claudia joins us now. Claudia, that is just fantastic framing. Can we just talk about how good this labour market is at a time where there are some question marks around it?
It's good. I mean, we are going to, in all likelihood, have another jobs day that is a day worth celebrating in general. We've had very strong payroll gains for years now into this. We've had the longest stretch of low unemployment since the 1960s, and we continue to have months of wages outpacing inflation. This is exactly what the labor market needs to be doing to get us back to a more balanced, normalized place and to deal with a lot of the harmful effects of the high inflation we have had already. So, I mean, this is really a good thing. And yet you can have two things be true. We have a good labor market, and it is weakening ever so slightly and gradually. We need to pay attention to both sides of that.
Claudia, you know what's amazing? When we catch up, I hear other people talk more about your role than you do. And I just wonder what you think about that. They're all citing it. They're talking about the next number, 4.2%. Then we've got a problem. What do you caution people with when you hear people talk about the rule that you came up with?
There is no simple solution or simple rule to assess what's going on in this very complicated world. Like, the rule had a purpose. I mean, I stand by the Somm rule. It has a logic. That's why I talk about we need to look at this gradualing of the labor market. And yet it's not to hang our hat on. And I absolutely am uncomfortable with people thinking about it as, oh, that's going to tell us we're getting too close to the edge. No. See, the Somm rule, it tells us we are in a recession. Right? If the Federal Reserve were to wait until the Somm rule triggered, they have waited too long, right, in terms of getting ahead of a recession. So it's about how we use the tool, and there's a lot of. It's really complicated right now to read the labor market. We saw that in the last jobs day. A lot of measurement, a lot of the immigration is playing a big role. That plays a role inside of the unemployment rate and the Somm rule as well. So to say this is a recession, or we're really, really close to one, that could be, but we don't want to be complacent about the other stories that are in the mix.
At the same time, Claudia, are you really interested to see the actual unemployment rate almost more than the headline number on Friday, just simply because it's more of a gauge of where the labor market is in a way that maybe the headline numbers don't give, given some of the influx of immigrants?
I mean, the unemployment rate, if you have to pick a summary statistic out of the labor market, that's the one to go to. And yet it's this really great thing. We don't have to pick one. Right, like we absolutely shouldn't, in terms of looking across the different pieces of information we have, and not just the labor market, how it fits with the inflation and the consumer spending. Like, this all comes in. That makes it much, much harder. We cannot boil that down into a rule. And yet, I take very seriously the labor market has weakened. And if you look, it is a gradual weakening that is not just the last few months. This has gone on for over a year. We have seen a drift up in the unemployment rate, and to have policymakers like the Fed with forecasts written down of, oh, the unemployment rate is just going to stay at 4% the rest of the year. And it's like, how exactly do your high interest rates do that? How do they stop a cycle? So I take it very seriously, and it is an absolute risk that I'm concerned about. And yet it's a risk that policymakers, the Federal Reserve, can still react to if they so choose. but they need to react. That window is closing to get ahead of that risk.
How big is that window, Claudia? Can you put some sort of time frame on it?
We talk a lot about the Fed working with lags, the monetary policy lags. Those lags, we don't tend to talk about them in the real economy, not financial markets, but in the real economy. Those are in terms of quarters, multiple quarters of the interest rate changes to take effect. So again, you can't, whereas financial markets may turn on a dime if the Fed steps up and we had to deal with some kind of market turbulence and can change things right, that day. That's not the same thing with say, getting consumers a little more breathing room so they can get out spending and balance things out. So I am concerned that as any momentum were to build in, deteriorating or weakening labor market, you just, what the Fed can bring to the table would be very slow moving in terms of the interest rate relief. And I wouldn't expect fiscal to bring anything to the table to be helping if we were to go into a recession.
Claudia, given the lags, I'd love for you to talk about this. I think on Wall Street, we have a habit of making a big deal out of small margins. We talk about a big difference between, say, July and September. How big is the difference if the Fed chooses to move in September over, say, July?
I mean, there's what's the difference in the real world in terms of the economic output, in terms of what it does to inflation, which is what this is all supposed to be about, is getting inflation back down while keeping unemployment low, versus what it does in markets. I worry, and if nothing else, it would be good to have the Fed start really working in the market messaging so this is not disruptive. To move away from the idea that when we cut once, we're cutting 4 times, and somehow they have to navigate that all with the market at once. Just go once, and then we'll wait and we'll see. There's just something has gotten way too amped up about this in terms of the market space. The Fed's got to get that under control, because we're never going to have certainty about is this exactly the right time to do this. But they need to have tried to keep some better control over it, not get just ridden by the markets.
Claudia, always a pleasure to catch up with you. We'll leave it there, but we will come back to you because you know what happens on Friday. Everyone starts to cite you. We'll see what happens with unemployment, and we'll come back to you. Claudia Salm there of New Century Advisors on the labour market and what the Fed should do. To Claudia's last point on the Federal Reserve, sort of get away from this idea that once we start, we have to keep on going. Is the ECB delivering a bit of a template for that right now, based on the last month?
It's trying to. We'll see, right? I mean, it's sort of the question of whether they're going to cut again in July, and basically Christine Lagarde saying don't expect it. Other people sort of saying we have no idea, we're not committed. That was supposed to be the template. Key question, though, for the Federal Reserve is just whether or not they can, given their guidance, given their data dependency, move in that way, just because. And it sort of goes to Mohamed El-Erian's point of how constrained are they by being overly data dependent.
9:30 Eastern Time, you'll hear from both President Lagarde and Chairman Powell from Sintra, Portugal. Coming up next on this programme, Oppenheimer's John Stolfus, Brian Gardner of Stifel, Bloomberg's David Welch, and Ian Steely of JP Morgan Asset Management. The second hour of Bloomberg Surveillance. Up next.
From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
I think we have to trade the earnings and the data that's coming at us.
There's room for downside surprise in earnings, but it may not be yet that we're starting that revision down cycle.
We probably have to pull in the expectations for the S&P 500 and then maybe be a bit more optimistic about some of the areas that have lagged.
Listen to the company's earnings call. Listen to them. They're all seeing weakness.
People look at the economy and say, that's fine, and then they double down on the bet on mega cap tech. None of these bets are going to get reversed until something shocks the system.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, the second hour of Bloomberg Surveillance begins right now from New York for our audience worldwide. Good morning, good morning. Your equity market is negative by 0.4% on the S&P 500. In many ways, the jobs data begins today. Job openings coming up a little bit later. Then you'll get jobless claims tomorrow. Then on Friday, a payrolls report. It's a big day for you. We'll also hear from Chairman Powell at 9:30 Eastern Time. Alongside Lisa, the ECB President, Christine Lagarde.
Who's taken an ambiguous, I should say, approach as to the ECB's move this month. There's going to be a real question, though, for Chair Powell about whether he echoes what we heard from Austin Goolsbee, re-emphasizing this idea that if inflation is slowing materially, then where the Fed is currently is restrictive, but increasingly so. And so that adjustment might be necessary. Are we going to hear the same thing from Fed Chair Jay Powell, indicating that maybe they are open to a sooner move on rates?
In the last 24 hours, these guys overshadowed by the politicians. Maybe even longer. The last couple of days, you include France in that, the last couple of weeks, throw in the UK, it's been the last couple of years. We're all thinking about this. What would a Trump presidency mean for this market? And how different are things in 2024 versus, say, 2016? Mike Wilson of Morgan Stanley, I think, put it really, really well with this quote. The market welcomed a reflationary pro-fiscal playbook in 2016 as the economy was recovering from the manufacturing commodity downturn of 2015. And inflation was broadly not a headwind for consumers. This is a different backdrop from today. And I think that compare and contrast, 16 versus 2014, really important.
Cameron Dawson of New Edge Wealth had the same kind of tone yesterday when she came on the show. She was saying, basically, when you take a look at the unemployment rate, when you began that Trump presidency, it was 4.7%, wage growth growing somewhere in the mid-twos, completely different than where we are to now. Inflation's more of a consideration, and frankly, the tax cuts, if extended, are not going to provide the same sugar, as Cameron Dawson said, as maybe some of the as it did back in 2016. These are the reasons why people are saying there aren't going to be the same kinds of economic boosts to offset potential headwinds created by tariffs, as well as some other more protectionist measures.
The Trump playbook of 16 was bond unfriendly, equity friendly. And basically the conversation we're having right now is, okay, again, bonds unfriendly. Will it be equity unfriendly as well? I go back to the performance of small caps in November 2016. We rallied that month by 11% on a Russell, on a small caps in America. Do you think that's the conversation this time around?
We're coming at a different level. Yields are already at a different level. Here is the ultimate question. At what point do bond yields affect stock valuations? We used to have this conversation before NVIDIA just took off and said, stop it already. That's a boring conversation. We have to reconsider that, though, especially if you keep seeing some of the other 493 names lag behind to such a degree, which is the reason why I want to understand this bond stock correlation a little bit better, outside maybe of big tech, which is a bit more noisy when it comes to this.
Well, let's get to the scores. This is what things look like right now. 2 trading days, Friday, Monday, a 17 basis point move on a 10-year yield. We pulled back just a touch. We're down a basis point on a 10-year this morning, 4.4494. In the FX market, the euro negative by 0.25%, 107.15. Mentioned Kit Jukes as SocGen in the last hour. Much more important for this pair, it's not rate differentials. It's not what the ECB or the Federal Reserve may or may not do. It is political differentials on either side of the Atlantic that could drive a stronger dollar and weigh on the euro.
But this is something you pointed out. Any political disruption can only be had on the European side because U.S. disruption evidently doesn't matter. If anything, it just sort of consolidates all the bets on the U.S. dollar, which just raises a question. Is there going to be any longer-term penalty? Is it just a dollar-positive, dollar-friendly bet, or is it also extended over into the treasuries? These are some of the questions that people don't really have answers to, despite some of the curve steepening that we've seen recently.
Euro-dollar 107.17. Coming up this hour, we'll catch up with Oppenheimer's John Stolfus as traders await fresh labour market data. We'll speak to Stifel's Brian Gardner on the stock winners and losers of a Trump presidency, and JP Morgan's Ian Steely ahead of Chairman Powell's remarks a little bit later this morning. We'll begin with our top story. Stocks looking for a fresh catalyst as traders weigh election risk and look ahead to key data. Oppenheimer's John Stolfus writing this: it is not uncommon in early bull markets for one or just a few sectors to gain traction and lead market performance before a broadening in performance takes hold. John's with us around the table. John, good morning to you.
Good morning, John.
John, it's amazing. We're talking to people about the labour market. They're flagging cracks, the prospect of an economic downturn, and you're talking about being constructive on consumer discretionary. Reconcile those two things for us.
Well, and I think that my viewpoint in looking at the economic data really shows a recognition of the fact that we've had 11 rate hikes by the Federal Reserve and now not eight pauses since March of 2022. It's natural that the economy will be slowing. We've been pumped up for quite a while, whether it was fiscal policy, whether it was the stock market, the economy in general. But I don't think we're headed into a recession. I think the Fed is going to manage to avoid a recession this round. And as a result of that, I think the market really cares about mostly about revenue and earnings growth. And I think that we've consistently seen to be remarkably resilient. And the consumer is resilient in the stateside. It's slowed, but it's buying discounted things. I mean, when I go to the store now, I'm buying private label.
So how do you want to play the consumer, given your personal habits and given what you're seeing across the economy?
I'd say related to the consumer, I can't mention, as you know, any specific stocks, but I like outfits that will discount brands. I'm always looking for sales.
Companies that look like TJ Maxx.
Yep. Yeah, there you go. Very much so. And in fact, I have to say we do own some in portfolios that I manage. But neither an endorsement to buy or sell.
Of course, understood.
Okay, but my point is in the U.S. we really describe ourselves, we justify ourselves by the availability of shopping and being able to shop, whether it's online, and we like competition, we love sales. And I think that persists. You know, having done this this is 41 years into this, it's always a bad thing to bet against the consumer. Now, the sector isn't performing well this year on a year-to-date basis, but that doesn't mean it couldn't shine from here to the end of the year, as people recognize the fact that we'll muddle along through into the end of the year and likely see a pickup next year. irregardless of who wins the election.
Spending is slowing down. Citigroup put out their card spending, and you did see that pretty consistently across the board. There is a feeling that, as we just heard from Claudia Sahm, the labor market is slowing down, and there seems to be sort of this tipping point where, at least in her view, the Fed needs to start cutting rates to get ahead of more protracted weakening. Is that important for you as well, for your stock call?
I think it's not as important as it is to some. When I look at it, I think the Fed is certainly cognizant of the fact that it is nearing the end of this rate hike cycle. In what the chair has said every time we come out of an FOMC meeting, it's obvious that they're planning to cut. They are reluctant to cut because they know how insidious inflation can be in terms of the flame up of inflation. What we haven't seen yet, and what I'm looking for, is really increased competition in the sectors. And that's competition is the enemy of inflation. And you do get to see that in periods where you're coming out of an inflationary cycle. Initially, those who've been, the inputs were infected by higher inputs are reluctant to pass it on to their customers. Then once the press and the Fed have recognized there's inflation, people just bite the bullet and spend more of their money to buy the same things. And then the resistance starts. And all of a sudden, you'll find within sectors, you'll find competition reemerges, where somebody figures out what they give up on unit pricing, they can gain in volume. And it just happens. And today with AI, with just where it is today, advanced logistics, all of this it's already begun. If you look at the names, well, with the names.
Just say what they rhyme with.
Yeah. Pardon?
Say what they rhyme with, the names that you're talking about.
Yeah, it's what you have to, within consumer discretionary, it's those outfits that send you the big boxes that you get every day. They buy in bulk, they are competitively priced, and people shop.
So the Walmarts of the world, the Amazons of the world, et cetera,
exactly,
they're basically, they're cutting prices and they're kind of driving some of this competition. So are you saying that this sort of gives you confidence that growth is sort of more of a threat right now than inflation? Sort of this question around whether or not it's a good time to take risk because growth is being threatened. How do you sort of play that sort of uneasy balance that certainly the Fed is grappling with, as well as the ECB?
Well, I would say one thing that's important to remember is that I'm an intermediate to longer term investor, so I'm not trading in and out on a daily basis, though I frequently can tweak a portfolio depending upon the individual or idiosyncratic situation of names within a portfolio. But if the trend that's occurring right now seems very clear. It's about technology. It's about the industrial infrastructure rebuild, all the way from chips to plants and equipment, training people not only here but around the world. It's about healthcare. It's about energy. It's about the financial sector as we get more normalized in terms of a yield curve. When I see rates, when I see the 10-year Treasury at 4.45, that looks pretty good to me. I can remember when the Federal Reserve had it as its inflation target 4%, and we just said, boy, oh boy, if we could get back to 4, 4% inflation, we'd sign up for life. It's like, give me an 8% mortgage, sign up for life. It's in different times. It's just we're coming out of a period of free money.
Yeah.
And people are spoiled. And I don't mean that it's not a let them eat cake moment.
Well, I appreciate that clarity, that correction. Let's talk about why the 10 years here over the last couple of days. How idiosyncratic was Thursday night?
Not as much as I think that people would really think. I think, if anything, and I say this completely politically agnostic, I think President Biden's performance was very well telegraphed by his performance since he took office, and he's been deteriorating in his ability to perform in terms of as in an act. When politicians have to, it's like getting on stage, and he fumbled badly. But I don't think people who act like it was surprising, I think we're in denial, and that's just the way it is. Do
you think the bond market responded to it?
I think the bond market is trying to really looking to get attention from the Federal Reserve and saying, give us.
Hold on a minute. The Treasury market's attention seeking.
Yeah.
Is that what you think?
I think. Listen, the bond market is. If you know bond traders, my gosh, they're
always looking for attention.
They're always looking for attention.
This feels personal.
This is. Let me tell you, when I go onto the trading floor, there's always a very different vibe from the fixed income area to the equity area.
They think they're smarter.
And it's a lot of it has to do. It's not only the skills of trading and finding the opportunities, especially today where people trade for bips. It's not. It's everything is. It's the spreads can be very narrow instead of wide. It's an environment where it's a combination of skill, ego, and people talk their book. You get like, I'm a bull, and of course I'm going to talk my book, but I base my book on fundamentals, and things just look. When I walk around the city, things are getting better. And it has very little to do with politicians. It's the business and the consumer are doing what they should be doing. They're showing up.
Good luck when you get back to work today. And you walk past the bond desk like that. John, it's good to see you. John Stolfus of Oppenheimer with the perfect description of dynamics on a trading floor in New York City. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. According to Bloomberg data, China's best-selling car brand BYD sold a record number of electric and hybrid vehicles in the second quarter. Price cuts and new tech helped the company sell nearly 1 million models. At 426,000 units, it's in striking distance of overtaking Tesla as the biggest seller of EVs globally. Tesla is expected to report second quarter deliveries this morning. The estimate is 439,000, alongside a slump in key markets like China and Europe. Now, a GameStop shareholder dropped a lawsuit against popular stock investor Keith Gill, a.k.a. Roaring Kitty. Martin Radev accused Gill of seeking to manipulate the stock for his own gain in a proposed class action suit filed on Friday. But late afternoon on Monday, Radev said that he was voluntarily dismissing the lawsuit. His lawyers didn't immediately respond to requests for comments, but the dismissal was without prejudice, meaning he is free to file the suit again. And the reigning NBA champion Boston Celtics are going on the market. Wick Grousbeck, whose family leads the ownership group, decided to sell the franchise for estate and family planning considerations, according to a statement. One of the other owners, Bain Caps Steve Pagliuca, wrote on X that he still hopes to be part of the Celtics moving forward. Boston won its 18th title last month, the most in league history. Sportico values the Celtics at $5.1 billion. That's the fourth highest in the league. It was purchased for $360 million in 2002. And that's your brief, John.
What a buy. What a buy. Danny, thank you. What a valuation increase as well. A lot of people asked the same question yesterday. Mark Cuban, Mavericks, peak franchise valuations here?
That was exactly what I was thinking. How much is this basically exiting at the top and then going into, more European football games, football teams that he would like to buy?
Let's talk with Steve sometime soon. Steve, I'm sure you're watching, so we'll catch up soon. Up next on the program, President Biden's uphill battle.
I've said to you before, I'll say it again. It's not going to ever be a case about whether Biden makes the grade one time. He's going to have to make the grade every time between now and the election.
And he's got a little more than 4 months. That conversation next from New York City this morning. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
The S&P 500 a little bit softer. We're negative. We're down here on the S&P by almost 0.5%, pulling back from yesterday's gains as we kick off the third quarter and the second half of 2024. In the bond market, Treasuries rallying, going against the grain of the last couple of trading days. We're down a single basis point on the 10-year at 444.94. Under surveillance this morning, President Biden's uphill battle.
You're going to have a Biden rescue effort going on over the next 7 to 10 days to try to mitigate that. And they also think, you know, they've got 4 months to turn this around. I've said to you before, I'll say it again. It's not going to ever be a case about whether Biden makes the grade one time. He's going to have to make the grade every time between now and the election in order to put himself in the best position to win. Now he's starting off a little bit behind.
Here's the latest. Democrats weighing moving up the formal nomination process for President Biden to as soon as this month. The DNC aiming to secure the president's place on November ballots and curb any speculation that he could be replaced by another candidate. Brian Gardner of Stifel saying markets should favor another Trump term, writing that banks and consumer finance win with Trump and lose with Biden, going on to say that big tech loses either way. Brian joins us now for more. Brian, we'll get into the trades in just a moment. I want to talk about Thursday night and whether that really moved the dial for you or whether a lot of this was baked as far as you're concerned based on what you've seen over the last few months.
So, you know, I went into the debate thinking that Donald Trump had a slight advantage over Joe Biden and that increased after Thursday night. And I think based on conversations that I had with investors, with clients, there was definitely a move within the market among the investment community that viewed it similarly, that Trump is in a better spot today. Biden clearly is weaker than pre-debate. So, yeah, it moved the needle a little bit.
Brian, let's run with that and talk about regulation and compare and contrast where we are now with this party compared to where we were in 2016. The Paul Ryans, the low taxes, those guys, those leaders, they're gone. And if I look at the party right now, I'm not sure how pro-business we actually are in the Republican Party because there are differences, as there always are, across parties. Have you got a clear read on that?
No, I think this has been an evolution in the Republican Party going on for several years. It is becoming more working class, more populist. As you noted, the Paul Ryans of the world are gone. Let me give you another stat, Jonathan, as we go into the tax debate of 2025, 2026. More than half of the House Republicans will have turned over since the 27 tax bill was passed. There's only going to be a handful of Republicans on the House Ways and Means Committee that were there for that last tax debate. And the replacements are more populist. You know, you look at a Marco Rubio from Florida, who in 2016, when he ran as a traditional Reagan Republican. He has clearly moved in the populist direction. J.D. Vance, another senator on the short list, could be Trump's running mate, really represents the ascendant populist wing of the Republican Party. That's not to say the entire party is controlled by the populists, but they are clearly ascendant.
Brian, to that point, why do you say tech loses either way?
Tech is just, tech is not loved, big tech especially, is not loved in either party. And the criticisms from the two parties are different. From Republicans, it's interfering in free speech. For Democrats, it's not enough content moderation. Then you get into the whole antitrust argument, and there's a lot more commonality on antitrust, that big tech is too big, it is too controlling, there's too much consolidation of power among too few players. And, you know, I'll go back to J.D. Vance, since I mentioned him a moment ago. He says that Lana Khan, the head of the FTC during the Biden administration, is one of Biden's best nominees and should be reappointed if there were to be a second term. So it just gives you the sense that, tech being a focus of the current administration, it gives you a sense that that members of both parties do not like tech a whole lot.
It also raises this issue of how different would a Trump administration be from a Biden administration, and how much is this really coming down to whether there's a sweep on one side or another. Brian, what do you tell your clients who say, is there a better chance of a Republican sweep after Thursday? And what is the implication of that when it comes to spending, when it comes to deficits?
So, yes, I do think there is a better chance for a sweep. I think one of the fallouts from Thursday night could be to dampen Democratic turnout. And so while, there could be a level of ticket splitting between the presidential and the down ballot races, if Democrats are dispirited and fewer of them, especially younger voters in key states, don't show up in the numbers that Democrats need them to, it raises the prospect of a Republican sweep. What does that mean going forward? Well, on spending, it's tougher. I mean, Republicans have been talking about spending over the last couple of years in this administration. Traditionally, Republicans will highlight spending and deficits when they're out of power and kind of look the other way when they're in power. The truth of the matter is that the federal budget math is getting such that you cannot look away from it when you're in power. So that is going to become a bigger fight within the Republican Party if there's united government. And on taxes, this goes back to the populist argument. Corporations are not beloved among a lot of Republicans, especially populist House Republicans. And so in this tax debate that's coming up, I think one of the things you could see, two of the things you could see is one, the top rate resetting and keeping the lower brackets at the current lower tax rate levels, and then bringing in the corporate rate and ticking it up a couple of percentage points to help keep the cost of extending those Trump tax cuts as low as possible.
Brian, got to squeeze this in. It's Tuesday, July 2nd. Tuesday, November 5th is about 4 months away. Does the Biden candidacy make it?
I think he will be the nominee, but I think time is running out very quickly for him to change voters' perceptions. One of the things we've seen in the polls, Jonathan, is that they are remarkably stable going back to the fall of 2023. Why is that? Because you have two candidates that are so well known by voters across the country. We can say it's early, but the fact of the matter is this is Donald Trump's third straight presidential campaign, Joe Biden's fourth time on the national ticket in the last 6 elections. That begs the question, what do voters not know about these, and how likely is it that they are going to change their minds in the coming months? And I think this is a different election because of that. I think we could know the answer of the outcome sooner than typical.
Interesting. Brian, well said. It's good to hear from you. Brian Gardner there of Stifel. On this race, 4 months left.
Yeah, although if the bond market's paying attention to the deficit, like the public officials, are they just looking for attention? Is that what we just heard?
I love the John Stolfus take. Just attention-seeking bond traders.
Think they know everything. Just want the Fed to pay attention. Give me love.
It's an interesting narrative. From New York City, this is Bloomberg.
face bigger challenges.
What's next? It was going to keep rate World Cup. This is a 3.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Two hours away from the opening bell, equities pulling back on the S&P 500 by 0.5%. Decent day yesterday for the Nasdaq. We take some of that back. We're down 0.6%. Lots of questions about the small caps. If you believe Trump Playbook 2016 works in 2024, we should be doing quite nicely on a small cap, shouldn't we?
Maybe, if you get the tax cuts, if you get a deregulation, if you have some of the smaller banks benefiting from that. But as a lot of people have pointed out, you're starting at a very different place than you were in 2016 in terms of the unemployment rate, in terms of inflation, which is higher, in terms of just how much of the tax cuts have already been implemented. So how much more sugar is left, as Cameron Dawson said.
The size of the deficit, the overall debt pile, yeah, it's a very, very different economic backdrop. Very different backdrop in the bond market, full stop, period. The end, 2016 versus 2024. This is where we are now. 2-year, 475.57. Yields coming back just a little bit on a 10-year at 445. Bear in mind, the previous 2 days, we have pushed higher by something like 16, 17 basis points, Lisa, in just 2 trading days.
Yeah, the biggest curve widening, the biggest increase of 10-year yields versus 2-year yields going back to early January as people try to suss out what some sort of sweep would be. Let's go with John Stoltzfus's discussion.
Attention-seeking?
They are attention-seeking. They're wondering when the Fed will wake up and see them. They're wondering when politicians will wake up and see them. If they really want to get attention, try harder, because this isn't going to do it. And that ultimately is what a lot of people are saying. As much as people cry and moan, you still have the Steve Eismans of the world saying, stop screaming away the deficit. I've been hearing this for 4 decades, and it never has changed. What is going to make a perpetual wake-up call will ultimately have to do with foreign investors pulling back, and frankly, a real ultimate question about if there's a better place to put your money, or real questions around the response function of fiscal in response to true economic weakness.
Steepner was a consensus trade for 2024, but Bear Steepner wasn't. So a lot of people just thought we'd get the Steepner, but it would be driven by a rate cutting cycle that would drive a rally into the front end. The Bear Steepner just wasn't on the radar, really, for anybody.
Especially at a time when people are saying that the inflation risk isn't that significant. People are saying that's not the big risk. It's a growth concern. That all goes to the bull steepening. But the issue is people are really, truly thinking, okay, if you have an increase in deficits and you have an increase in tariffs and you have fewer immigrants, then you're looking at a very different scenario that potentially could pose a bit more of a challenge.
Reignite inflation risk, and Adam Posen of the Peterson Institute, I think, really started the conversation about 2 months ago, sat around this table and said, hold on a minute, look at what's here. Look at what's in this package, what could be delivered. In 2025, we might be talking about rate hikes again.
Part of the problem is that when anyone talks about this, and you heard this with John, this isn't political. People trying to distinguish the idea of talking about this objectively at a time where there is so much, I guess, subjectivity injected into this. And anytime you mention either of the presidential candidates, you're accused of one side or the other, or over-obsessing over this. The bottom line is there are real implications. The question is just what's going to get through. And if you take the former President Trump at his word, there could be a pretty inflationary policy.
I always go back to a phrase that Mark Dow used out on Twitter 8 years ago, when he said that the biggest challenge for an investor in this political backdrop was to divorce your political bias from your market call. Because so many people thought the Trump candidacy would be bad for markets. It was good for markets. Markets were good. They were decent. It was the policy backdrop. And I'm with you. You have to divorce your politics. Whatever you feel about either political party, either candidate, either individual, it's about the policies. And it's not just about the policies in isolation. It's about the policies against the backdrop that we're in right now. And I'll go back to what we talked about a little bit earlier this morning. In 2016, this bond market was crying, begging, demanding for there to be some kind of pickup in the fiscal impulse. In fact, Fed chair after Fed chair was going in front of Congress, practically asking them to do it. That's where we were in 2016. That's not where we are in 2024.
That's the reason why I think one of the most important things is going to be to see who Donald Trump nominates as his vice president. Is it going to be a J.D. Vance, or is it going to be a Glenn Youngkin? That could give you a sense of what the actual policies will be and whether it's going to be business-friendly or whether it's going to be much more in the populist vein, more akin, frankly, to some of the Democratic points of view.
Not as clear this time around. Not that it was clear last time around, given how some people positioned for it. Let's turn to foreign exchange. We need to talk about the euro and the Japanese yen. So Christine Lagarde's kicking off the get-together in Sintra, Portugal. ECB forum, a little bit like Jackson Hole, but with an ECB twist. So she's opened that up. She's talked down rate cuts in July of 2024, hardly parking them for the rest of the year, but I think maybe offering a template for what we could see from the Federal Reserve, that once they start, it doesn't mean that they go meeting after meeting after meeting after meeting.
Which is something that we've been hearing from a lot of people, a shallower rate-cutting cycle. Just on your point about Sintra being like Jackson Hole, I feel like this is actually a cultural difference. The Jackson Hole, you go hiking, you stay in this sort of rustic lodge, and Sintra is this gorgeous, luxurious sort of place in Portugal, in a vacation spot, overlooking seas and having beautiful food. It's just a very different kind of scenario.
Yeah, the date's important too, because in Europe, after this, you take the rest of the summer off, and then for some reason, the Federal Reserve does its get-together in August.
Yeah, right before you kick off the year.
Right.
It makes a lot more sense when it comes to business, but not living. It's more living to work rather than working to live. It's sort of the classic differential.
The clash of the European and American cultures. I know. All right. Under surveillance this morning, President Biden looking to shift the narrative away from his age and towards Donald Trump's behavior, calling on voters to render a judgment on his opponent in response to the Supreme Court's ruling that Trump has some immunity from criminal charges. Try as he may, you can't get away from what happened on Thursday night, and they're going to struggle to.
And that's ultimately what we're seeing currently. You could make all sorts of discussions about the Supreme Court and some of the 6-3 rulings that have come out that have been fundamental. I think that Chevron case actually is more interesting from a business perspective. That said, the issue is people have already known all of this. And the Supreme Court isn't changing the narrative. Joe Biden isn't changing the narrative. It will take something a little bit more substantial.
I had one suggestion. If he wants to put to bed, if the campaign really wants to make out that Thursday night was just an anomaly, do a press conference. I heard that suggested yesterday. Do a press conference, a couple of hours, take questions from reporters repeatedly, and just show that that was a one-off on Thursday night.
Do a full court, don't protect.
Easy.
Put them out there, stop trying to shield. And that would be the one thing that could potentially shift the narrative.
It's not what we've seen over the last couple of days at all. Our next story is this one right here in New York. Manhattan home sales unexpectedly rising for the first time in 2 years. Data suggesting buyers may be viewing this period as a good time to make a move before the Fed starts easing. Things are picking up. We're greasing the wheels, so to speak, in Manhattan.
So I was looking at this article and I was thinking to myself, I wonder why. And how much is because people are expecting rates to go down? They could just refinance, right? I mean, basically they're having a put on where valuations are, which have had something of a ceiling as a result of where yields are, where mortgage rates are. And if you think about it, if the Fed's going to cut by 50 basis points or even 100 basis points, they can refinance and get a lower premium they're going to pay every month.
Implicit in that, though, is this underlying assumption that prices go up when they cut. Do you think prices go up or prices go down?
You know, I've heard arguments on both sides. And frankly, I don't have more clarity on it. There's this argument that if you have more supply coming into the market because more people are moving around, and that would happen after mortgage rates went down, that you could see prices go down. And then other people say this pent-up demand is so great, and the lack of housing is such that there would be resilience. I have a sneaking suspicion it depends on which area you're talking about. I have a sneaking suspicion that the Sun Belt, you're already starting to see some house price declines. Some of the areas that got bid up most after the pandemic might look a little bit different than some areas, particularly in the Northeast, that didn't get bid up quite as much.
Could be very, very regional. Let's turn to Tesla. Analysts expecting Tesla to report another quarter of weaker sales. The predicted 5.8% drop from a year ago would mark a second consecutive quarterly decline as the company struggles to continue its market dominance. Bloomberg's David Welch joins us now from Detroit for more. David, let's talk about the numbers. What are we looking for compared to where we were, say, last quarter? And what does the trend look like over the last year?
So we're looking for a nearly 6% decline from Tesla, and that's probably pretty reasonable because their China deliveries were down 24%. That's a very big number. And so you have two quarterly declines here, and the rest of the year it doesn't look a heck of a lot better because the product is kind of stale. There's a lot more competition. Tesla had a near monopoly on EVs in the U.S. market, and a lot easier competition in China and even Europe over the last 4 or 5 years when they had this fantastic growth that everybody is still looking for to somehow, out of providence, revive itself. And it's not. There's just too much competition now. You have General Motors, you have the Europeans gaining traction with their new EVs. Even Honda's got a couple out now. Even if they only sell them in small numbers, they're taking market share. On top of that, you've got consumers scratching their heads over whether it's time to go electric. That's not helping them. And I think this is subjective, but I think Tesla has a styling problem at this point, and that is the cars all look alike. They all have that same look that debuted with the Model S in 2012. It hasn't really freshened up, with the exception of the Cybertruck, which is not selling in big numbers at all. So you throw all that together, there's just not a lot that's really going to energize sales for them unless they really do, as Elon Musk has hinted at, come up with some really fresh product in 2025 and 2026.
Whatever these numbers look like, David, you know that for the bulls on Tesla stock, they'll just say August 8th, it's on the calendar, it's a big one, the robo-taxi's coming, that's going to change the game. How do you think about that?
Look, that's going to be really hard. You look at what the problems that General Motors has had with Cruise, and okay, if you want to say that's a one-off, that's one company doing robotaxi that didn't work, but for Tesla it will. Waymo, which is Alphabet Inc.'s self-driving car company, they've been at this for more than a decade, and they're still only launching these vehicles in select markets in small numbers. The robotaxi business itself is not generating huge revenue and great margins for them yet, and they've got some very good people working on this, again, for a long time. So how is Tesla going to come storming out of the gate with a robotaxi business that's suddenly going to change revenue and earnings for them? Look, it's a lot of people have lost money betting against Elon, but it is just until we know exactly what they're announcing, it's tough to see this thing quickly turning around the perception of the stock and the actual revenue and margins for this company. So now, could it generate enough hype because it looks really good in terms of the business plan for it, that it gets investors excited again? I think that's what they are relying on, and Elon's very good at keeping the narrative going and keeping people interested. So we'll see. I just don't see the robotaxi business itself generating huge numbers in the first year or maybe even couple of years. It's just a very difficult technology to perfect and a very difficult business model to execute.
David, we spent a disproportionate amount of time talking about Tesla, in part because we can't decide whether or not it's a tech company or a car company. I'm actually more curious about the car company side of it, and frankly, the other auto manufacturers that are going to be reporting some of their sales figures coming out today and throughout the month. Ultimately, there is a huge macro problem facing them, and you're starting to see sales slow more generally, just simply because the average auto loan has a rate of 10%. People cannot afford buying a new car in the same kind of way on credit that they did, say, 3 years ago. How much are you expecting this to sort of turbocharge the declines that we may see today and the rest of the week?
I'm not sure we'll see a big decline in vehicle sales. I mean, I think it could be down because a big chunk of U.S. dealers have been basically doing vehicle sales by paper because of this CDK cyber attack, and because, look, your bigger point is pricing of vehicles and interest rates. The overall affordability calculation is pretty rough on most consumers right now, and that's what's sort of leveled things off. I don't think it's going to be a terrible quarter, but it's not going to be a great one either, and we're still looking at sales numbers that are a bit below where they've traditionally been, which is more than 16 million units every year. Vehicles are still pretty expensive. Car companies are still kind of playing this game where they're avoiding discounting. They're keeping prices high because it's better for profitability, but consumers are squawking and saying, hey, no more. I'll just keep driving my vehicle for another year or two, and the repairs aren't as expensive as the monthly payments at today's interest rates, so I'll stick with that. And it's sort of like college tuition. It's at some point consumers say, I'm not going to pay it anymore because it's too much, and that means car makers are going to have to start discounting if they want to keep the volumes up. And you're seeing a bit of that. Hyundai and Kia are doing it. You've seen a bit of it from Stellantis. Ford and General Motors, I think, have held pricing, but we'll see how the numbers come in. But I think if they want to keep volume going, they're going to have to get prices. They're going to bring prices down, and not to crazy discounting levels, just something that's closer to pre-pandemic levels. You're still seeing people buy vehicles at well above pre-pandemic prices right now.
It's a tough market. It's super, super competitive. David, thank you, sir. David Welch there of Bloomberg, looking ahead to those Tesla delivery numbers. A little bit later, in about 30 minutes from now, we'll catch up with Ben Callow of Baird. Looking forward to that conversation. 2 negative quarters of growth, and we're talking about a growth company here with a lofty multiple. That'll be the conversation in about 30 minutes' time. Let's give you an update on stories elsewhere this morning. With your Bloomberg brief, we can cross over to Danny Berger. Hey, Danny.
Hey, John. President Joe Biden's campaign says it raised $127 million in June. That is the best fundraising month for the campaign of this election cycle. It also includes $38 million that was raised in the 4 days starting Thursday, which was the day of the presidential debate. Biden aides have pointed to that ability to rake in cash despite his performance as evidence that the president retained his party's support and has not irrevocably damaged his campaign. Former Microsoft CEO Steve Ballmer has passed company co-founder Bill Gates on Monday to become the 6th richest person in the world for the first time. More than 90% of Ballmer's $156.7 billion fortune is in Microsoft shares. Gates, for his part, has diversified his wealth and slowly has been reducing his fortune through philanthropy, building the $75 billion Gates Foundation. Hurricane Beryl is now the earliest ever Category 5 storm in the Atlantic. Beryl, with maximum sustained winds of 165 miles per hour, is headed towards Jamaica. Typically, the first hurricane arrives in the Atlantic by August 11th, according to the Hurricane Center. With 3 storms already in the books, the season is running ahead of pace. Early forecasts called for this to be an active year. And that's your brief, John.
That's what it looks like. Brutal. Danny, thank you. More from Danny in about 30 minutes' time. Up next on this program, election risks move the market.
I do think that what happened on Thursday meaningfully increases the likelihood of a Republican sweep in November. Tariffs are a elixir for stagflation. Tariffs slow growth and push up inflation at the same time.
That conversation up next from New York. You're watching Bloomberg Surveillance.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that, moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Let's show you some of the scores. The price action looks like this on the S&P 500. We're negative by, let's call it 0.5% on the S&P. The bond market is where all the noise has been over the last couple of days, particularly at the long end of the curve. Very quiet at the front. Yields lower by a single basis point, 4.4534 on the US 10-year. Under surveillance this morning, election risk moving the market.
As an investor, perhaps it's a bit early, but you can't really ignore what happened on Thursday. Renewal of tax cuts and tariffs, all of those things end up being somewhat inflationary.
I think that the risk is that yields do move higher, because the other thing we heard from the debate is that neither party is considering austerity.
One of the more controversial policies that the Trump administration is talking about is inflationary.
Now, tariffs are a elixir for stagflation.
It's the talk of Wall Street over the last couple of days. Here's the latest. Bond traders weighing the potential economic implications of a Trump victory in November. A growing chorus of Wall Street urging clients to position for sticky inflation and higher long-term bond yields. Ian Steely of JP Morgan Asset Management joins us now for more. Ian, this has been a question we've been leaning on over the last 24 hours, all the way back to Friday. What does Thursday night change for this bond market?
I think Thursday night brings into perspective for the market that the election is coming up. So I think the market only likes to focus on a couple of things at once, and maybe it had parked the election for the time being, was looking at what was going on in Europe and possibly some slowing from the US economy standpoint. But now, obviously, Thursday brought the election front of mind again, and what could happen, as we just heard from those clips, around tariffs, around taxes, and ultimately, would that keep inflation sticky, or would it even elevate inflation further? And then what does that mean for the long end of the bond market? And that's really what the market's been digesting over the last 48 hours of trading or so.
Yeah, let's talk about the shape of this bond market and how things have evolved over the last couple of days. So coming into this year, we had the curve deeply inverted. It's still inverted, 2-year out to 10-year, right across through the curve. And a lot of people were looking for the steepener, but they thought it would be driven by a rate-cutting cycle that would fuel a rally at the front end of the curve. That's not been happening. And what's happening is this so-called bear steepener, which you know is driven by a sell-off in the longer end of the curve, yields pushing higher. How sustainable do you think this evolution is?
I think you've got two components of it. So the front end remains reasonably well anchored, because we've heard categorically from the Federal Reserve they do not want to hike rates further from here, and they do believe the next move will be a cut. So that does keep 2-year yields pinned to some extent, and we've seen that over the last couple of trading sessions. And then it's the long end which can really move around. It can wax and wane with what the market's expectations are for demand and ultimately supply. And it's that supply that's going to come to the market if we are expecting further deficit increases across the US. And it's really that's been concerning the market to some extent. And a lot of people, as you said, have been positioned for this steepening to occur, and the trouble they've had is that it's negative carry. There's a cost to owning the steepness. Having that steepener on hasn't worked, so a lot of people then moved out of that steepening risk, and then we've had this knee-jerk reaction over the last couple of days.
Just to put this very simply, Ian, is this a buying opportunity on the long end for you?
I would argue it's actually more of a buying opportunity and more of intermediate bonds, because I do believe the long end is going to, say, move around based on what we're hearing around the election risk, where it's that front end, it's the intermediate, the 5-year part of the curve that's going to be held down by what the Fed's up to. And that, I think, is going to be more, you get more confidence that those areas is where you're buying. So if you think about the convexity of a 2-year bond today, we're at 475. We're pricing, a couple of cuts in. Imagine they don't do that. Imagine they just do one. Well, maybe yields move a little bit higher from where we are today. But if things do go wrong, if you do get a sudden slowdown, if we get a bad payroll print on Friday, you could see those yields move remarkably lower. So I think your risk reward for owning the front end makes a lot of sense. I think it is more challenged in the back end.
There's this ultimate question, and John was asking this earlier, this question of why is the U.S. immune to political risk being a liability for the nation's currency, for the nation's bonds, just in a point-blank way, the way it is, for example, in France, the way we've seen kind of stay sticky. Is there going to be a point at which either there's going to be convergence with French bonds getting a rally, yields coming in more aggressively, or on the flip side, this type of move to be sustained simply because people are sick of it with the U.S., feeling like it can always just have the privilege of acting recklessly?
I do think the U.S. gets a bit of a pass, given it's the reserve currency of the world, but I don't think they're completely immune to it. And I think that's what we've seen over the last couple of days, that ultimately when the considerations are that you are going to get a lot of supply to the market, that needs to be taken down. Someone ultimately needs to buy that, and if people want to buy it, maybe they need to be compensated a little bit more, so we're getting higher yields on the back of that.
75 basis point spread, something like that, Ian, between Germany and France. Lisa asked this question yesterday. I think it's worth repeating again. Do you think this wider spread between France and Germany is the new normal in Europe?
I do think it is a new normal. So I think what we've seen just since the results on over the weekend, it does feel that some of that tail risk of a left majority, or that the tail risk of a left majority has been removed. We're going to find out over the next couple of days and over the weekend what actually happens in France. But I think fundamentally it does mean that France is more of a deteriorating story. So yes, you can see a little bit of a relief rally, and we saw a bit yesterday, and maybe after next weekend you'll see a little bit further. But that would, to me, be somewhere in the 60 to 70 range for that French-German spread. I don't see us going back to 40 or 50, which is where we were pre the election. I think there's just a perceived risk now in France that wasn't there earlier this year.
So, Ian, I'd have to say, you know, would you see it going to 100, 150 then? And if you don't, is it a buy right now?
I think it is a buy. We've started to lean in a little bit. I do think there is the ability for spreads to go wider, but you would have to have, you know, similar to what we've been talking about for the US, you'd have to have more concerns that there will be some loosening of the fiscal side. And I think the right wing, they are looking at the 2027 presidential elections. They want to be seen as credible for that. And then they're also looking backwards at what happened in the UK 2 years ago and not wanting a repeat of that. So I do think there will be some fiscal restraint. We've heard that from them. So I don't expect us to go to the 100 basis or 150 basis points level. That could be a concern. I think we consolidate around here. Ultimately, you do want to be owning it at these levels, but you're probably not going to get a huge amount of satisfaction if you're only going back to, say, the mid-60s. I think there's more opportunity in what I would call slightly better credits like Spain or places like Italy where there's more valuation.
Just real quickly, Ian, earlier this morning we had John Stoltzfus on, who said that a lot of the move that we've seen in treasuries has just been bond traders looking for attention, thinking they know everything, and just trying to maybe get some recognition from the government or from the Fed. Do you think that that's true characterization?
No, I think it's ultimately you go back to the fundamentals and you go back to the technicals, and you believe that if we are going to have a higher deficit, if we are going to have more supply to the market, you know, bond investors want to be compensated, so they need higher yields for that to happen.
Ian, it's good to hear from you. Ian Staley of JP Morgan, and what's happening in Europe and in the global bond market. It's amazing to keep hearing the same thing, that ultimately the strongest pillar of the bond bull case in Europe is that nobody wants to be Liz Truss. Isn't that amazing?
I mean, this is basically the argument that essentially the market's going to discipline a lot of populist governments.
Yeah.
And that essentially that was already tested and done and dusted. Unclear. I guess that's really the question. One story that I was watching overnight was this idea that the union on the left and in the center in France is kind of splintering, and you're seeing that in a more significant way. If that truly does splinter, do we start having a different conversation about just how much discipline this market can inject on any kind of populist policies?
And let's see where we are Monday morning in that French bond market. Coming up, in a third hour of Bloomberg Surveillance, we'll catch up with Matt Miskin of John Hancock. We'll speak to Ben Callow of Baird on Tesla. Looking forward to that. Ian Lingen of BMO calling it political provocation in the bond market. It's quite a phrase in the last 24 hours. Dean Mackey of Point 72 joining us as well. Dean's going to break down what he's looking for in the labour market with jobs coming up just around the corner. Head of payrolls on Friday and jobless claims tomorrow from New York. All of that still to come.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Aman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
It's It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
We've been anticipating an inflection point in the economy, so you're going to see some flexibility in the data.
We're not at the point yet where things are falling off a cliff, but we're definitely coming off the boil.
If you factor in the Fed policy and how the Fed will have to react to inflationary environment, that could really push growth down.
As far as the Fed is concerned, we should take them at face value. The driver for them has to be really real-time data.
Once bitten, twice shy. Most likely, I think they're going to be a bit late and a bit behind the curve here.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, the third hour of Bloomberg Surveillance begins right now from New York, looking ahead to two things. Looking ahead to jobs data at 10 a.m. Eastern Time, job openings in America. Before we get there, 30 minutes before that, you will hear from Chairman Powell in Sintra, Portugal. Here's a preview, not mine, this belongs to Citi. Dovish signs from Sintra. Andrew Hodenhorst expecting the following. We expect Chairman Powell to strike a dovish tone as economic activity and prices have both slowed, according to recent data.
Well, he says this at a time where they're expecting the jobs print on Friday to be 155,000, down from the expected consensus of 200,000. But frankly, it comes after Austin Goolsbee really did signal a dovish tone, which is as per usual, since he does tend to have a more dovish tilt, talking about how, given how much inflation's coming down, they will be overly restrictive if they keep rates where they are. The whole idea of a mid-cycle adjustment really coming to the fore.
A great exchange with Francine Lacqua a little bit earlier. We've heard signs of this now for the best part of 12 months, that they don't want to be responsible for passive tightening. What's interesting to me is that it's gone quiet in the core of the committee over the last couple of months, because this would really speak to a mid-cycle adjustment. Just do a couple of moves, settle things down, and then look ahead, wait for the data, wait and see. Why isn't that the dominant conversation taking place on the FOMC going into July?
Because there are some signs of sticky inflation that continue, and whether it's in housing, which has continued to be a complete mystery, I would say, for a lot of people, whether it has to do with commodities, also showing kind of conflicting signs, or whether it shows to a stickiness in services spending, there is an uncertainty of just whether the inflation beast has truly been killed. There is an issue as you look forward about whether to focus on the ISM manufacturing that came out yesterday that we're not even talking about. It came in disappointing, but it also showed a disinflation. under the hood when it comes to some of these goods? Or do we focus purely on services, and we do get the ISM services tomorrow to see whether we do have that same disinflation trend there? That might be the key for the center of the committee.
3 straight months of contracting factory data. Just to return to the calendar again, later this morning at 10 a.m. Eastern Time, job openings. Tomorrow, the big one, because the market's closed on Thursday, you'll get ADP, you'll get initial jobless claims, you'll get an S&P Global PMI, you'll get factory orders, you'll get the ISM Services Index as well, Lisa. That's quite a 24 hours coming up on the data front.
A data dump ahead of the key one on Friday, where everyone's going to be at the beach, but they're going to have to dial back in so that they can trade around what gets out from the non-farm payrolls. To me, of all of those readings, potentially any kind of aberration could move the dial. To me, today's jolt up job openings might be the most important. If they come down to that pre-pandemic level, which is as expected, 7.9 million openings, people are saying that will move the dial, because all of a sudden we'll be talking about a normalized labor market that's inflecting downward, to Claudia Sam's point.
Will we be talking about normal or something more sinister? Let's go back to the framing we've used on this program over the last, I think, 3-4 months. The difference between a welcome cooling and an unwelcome deterioration. If we get downside surprises on jobs data, do you think this market is willing to see that through rose-tinted glasses anymore, to say that's a welcome cooling and not an unwelcome deterioration?
Which market? I would argue that probably the front end of the yield curve has already started to sniff out a little bit an unwelcome cooling, which is sort of speaking to the fact that you have a couple rate cuts being projected out. You mean the equity market? Some people would say that actually the other 493 stocks have already sniffed that out. The Russell 2000, very much smelling that kind of weakness.
Stocks negative again this morning. Some weakness for you this morning. We're negative by 0.5%. The scores look like this in the bond market after the 2-day sell-off Friday, Monday, following the events of Thursday night. Stateside, yields are lower by 2 basis points, taking some of that sell-off back. Your 10 years at 4.44. In the FX market, talked a lot about Chairman Powell in Sintra, Portugal. The ECB President Christine Lagarde speaking just yesterday to open up that forum, pouring some extra freezing cold water over a July rate cut at the ECB. Euro 107.28. We're negative about a 0.1%. Coming up this hour, we'll catch up with John Hancock's Matt Miskin as investors weigh second half risks. We'll speak to Baird's Ben Callow as Tesla reports second quarter deliveries a little bit later today, and BMO's Ian Lingen as Wall Street maps out how a Trump victory would impact the bond market. We begin with our top story. 90 minutes to go until Fed Chair Jay Powell speaks at the ECB forum. John Hancock's Matt Miskin saying this: the Fed is likely to be one of the few central banks that can't cut yet. All the cool kids have cut, but the Fed is being left behind. The last inflation report was good, but one report does not make a trend. Powell likely reiterates that they need further evidence to be confident that inflation is going to their 2% target. Matt Miskin is with us now for more. So Matt, would you say, I'm not going to say they're ignoring some of the weaker labour market data, but it's not as important, the developments in CPI?
Initial jobless claims still at around 200,000 is fine. You know, if you look at initial jobless claims as your primary input, because that's going to be really the signal that's going to show you that the labor market is deteriorating. At 230,000, it's still not bad. When it gets to about 300,000, that's when the Fed is going to have to pivot hard and start to cut. But the inflation data just in the last month was great, and we all celebrated, right? But in Q1, it wasn't great. And we need more data points, in our view, for the Fed to be confident. Look, you're getting paid great yield in the United States bond market right now. Just be patient. The higher yields right now is a gift. I know we've been talking a lot this morning about it maybe being politically driven. But if inflation does come down over the course of the year and eventually the Fed does cut, this higher yields will be an opportunity. That's what we look at in this bond market today.
You went to the politics, so let's go there too. I'll add to it using your words. There is a lack of geopolitical risk being priced into markets with an elevated PE on the S&P 500 at 21 times and high yield spreads at only 3%. Regardless of the election winner, either one will be taking an economy that has been benefiting from massive fiscal stimulus that is unsustainable at this pace. John, we've been asking this, Matt, we've been asking this repeatedly. Thursday evening, how does it change this bond market, not just for the next week, but for the next 12 months?
I just don't see it, John, in terms of what it does. I think you actually said it best, I think, earlier, where you said it's all about the context. Think about, under the Biden administration, the best performing sector has been the energy sector. And I'm not talking alternative energy. I'm talking drill, baby, drill, Texas energy companies. Now, how did that happen? It's because they were down a lot prior to the 2020 election. They were really cheap, and they did recover. It was the private sector. The private sector is going to be dominant here, and we're coming off of all this fiscal policy that's likely to decelerate regardless of who is in office. We think the bond market is getting a bit spooked, but we actually believe that over time it's going to be inflation that drives it. If you don't have a major pandemic or shutting down the economy or therefore fiscal policy that is historic in nature, that trend probably continues. So we really think it's all about the context, and whoever's going to be in office into the next 4 years is likely going to be seeing a deceleration in inflation back to the old demographics driving the narrative and the backdrop of growth environment. And things are expensive right now in terms of equities. And so in our view, we would, again, look at this backup and bond yields as an opportunity. We would look at defensive parts of the market as an opportunity because there are some risks out there. But politically, we would divorce that from your investment decisions.
So a buying opportunity when it comes to 10-year yields in particular, is that what you're saying? Because we were just talking earlier with Ian Steely, and he's saying, that's kind of a risk. Maybe just stay in the belly.
Yeah, I mean, we do like the 10-year. And right now, you think about the intermediate part of the curve, we are getting about 5% on the U.S. aggregate bond index. The highest in the last 20 years is just about 5.9. So, it is still near those highs of the last 20 years. If you could do 5 to 6%, even with a little bit of a credit bias over the next 5 to 7 years, we think that's going to be a really attractive risk-adjusted return. And right now, again, you're thinking about, trading this around all this economic data, the election. Just think about, high quality bonds. If you get that over the next 5 to 7 years, that's really what bond investors should be focused on. Not the day-to-day, not all the noise. Right now, you really need noise. You need headphones right now that are going to be really good at noise canceling. That's what investors should be focused on is just the income component. And on a global basis, I know, Lisa, you've been talking about this. On a global basis, U.S. yields are really attractive. They're the highest versus Chinese yields in history. They're a lot higher than European yields. They're a lot higher than Japanese yields. So you've got the best yields in the world. You got to be patient for that duration tailwind. But when it comes, you might get 5 years of bond returns in 12 months. And if you're out of it and you're not there, you're not able to get it.
Which raises questions about just how bearish you are on the U.S. economy, frankly, because it means that you think that that inflation is going to cool and that any new president is going to be dealt a pretty bad hand when it comes to fiscal stimulus coming off, inability to really stimulate more, and a lot of the right sizing, et cetera, already happening in a lot of companies. What does defensive mean in an equity market where some of the big tech names have been called defensive, growth, value, and everything else?
Yeah, so the quality factor and the momentum factor, frankly, have been just dominant in the U.S. equity market. And we still like the quality factor. I mean, you think about good balance sheets. You don't need cost. You don't need capital. Companies that don't make money right now need capital, and it's really expensive. We think that's going to continue for the end of the year. And then we think defensive equities like dividend payers, utility type companies. We think those actually get more love into the end of the year and into next year. They have been cheapened up. They've been unloved. And even in bonds, higher quality bonds have really lagged credit. They lagged equities. Those could actually make a comeback into the next year. So, there's a lot of defensive options. In terms of the economy, we do think it's okay, but it's hard to get a real gauge because it's been just so medicated with all this fiscal stimulus. And you take that off, the Fed's going to have to step up and be the next one to stimulate. And we think that's a 2025 story. So we want to position before that. And there's a lot of defensive options on sale in case of any confidence exogenous shock that does happen in the next 6 months.
Matt, I've got to ask you, do NVIDIA make noise-canceling headphones?
That'll be the next thing. I know Apple with a robot or something like that, and next noise-canceling headphones. But investors are going to need nerves of steel, John. And you guys are going to be in the forefront of it. It's going to be interesting either way, but for us, it's really about educating and making sure investors are focused on the things that drive markets like earnings, the economy, and focusing on risk management.
Appreciate the education. Thank you, sir. Matt Miskin there with John Hancock on this bond market. Equities too. Serious dimension to that question. When we're thinking about noise-canceling headphones, they're made by the Treasury, they're made by NVIDIA. What are people really seeking out right now to sort of cancel out the noise?
They have been made by NVIDIA for the past 6 months, which is the reason why those shares are up something like 140%, because people are saying, ignore the political noise, ignore the macroeconomic noise, just take a look at the cash machine that is NVIDIA and say, yeah, that sounds good. Question now is just whether it's gotten so bid up, and I go back to that Torsten Slok statistic saying that basically the top 10 stocks account for more than 30% of the S&P 500 when you look at the market cap, but only 24% of the expected profits. That is the issue. At what point have people gotten over their skis with what they expect? From behemoths that are cash cows currently, how long can they continue to have those incredible billion-dollar beats?
NVIDIA down this morning by 1.2% in the pre-market. The broader equity market down as well. We're down about 0.4% on the S&P 500. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. After the Supreme Court ruling, Donald Trump is making a fresh push to have his New York hush money conviction overturned. The U.S. Supreme Court ruled yesterday that Trump has substantial immunity from criminal prosecution for actions taken while president. Bloomberg reports that Trump's lawyers are taking steps to request that the verdict of his New York trial be tossed out. The lawyers are also proposing delaying his July 11th sentencing. And more home buyers in Manhattan are taking the plunge instead of waiting for rates to come down. According to firms Miller Samuel and Douglas Elliman Real Estate, closings for co-ops and condos spiked 12.2% for the second quarter of this year compared to last year. The median price of $1.18 million is slightly down, but still near record highs. Deals closed with a mortgage were also up 15%, while deals closed with cash were up just 10.6%. And a GameStop shareholder has dropped a lawsuit against popular stock investor Keith Gill, a.k.a. Roaring Kitty. Martin Radev accused Gill of seeking to manipulate the stock for his own gain in a proposed class action lawsuit filed on Friday. But late afternoon on Monday, Radev said that he was voluntarily dismissing the lawsuit. His lawyers didn't immediately respond to requests for comment, but the dismissal is without prejudice, meaning he is free to file the suit again. And that's your Bloomberg Brief, John.
Danny, thank you. We'll touch base with Danny again in about 30 minutes. Up next on the program, we'll get you some morning calls, plus Baird's Ben Kello as investors await Tesla deliveries a little bit later on. That conversation coming up next from New York City this morning. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Let's check out the scores and go to the bond market first. I want to talk about treasuries just briefly. Treasury yields repricing higher over 2 days, Friday, Monday. Yields are a little bit lower today by 2 basis points at 443.75. What would change this story? Andrew Brenner and Nat Alliance. We need a dovish Powell, good jolts, and a good non-farm payroll to stop the steamroller ride of bonds towards higher yields and a steeper curve. We're not optimistic in the short end. The election cycle has now made its way into the bond market, and don't forget to keep the yen and oil on your front screen. This is important, the election, and what it means for this bond market going forward.
Especially given the oil, and I'm glad that he brought this up, given the fact that there is this increase under the hood in crude. Look, this is really the big debate. When do people get conviction to go into long-term treasuries at a time where there is a lot of uncertainty politically, and it's not clear that the Fed could get ahead of that? Didn't we hear from Krishnamurti? The Fed is sort of de-emphasized right now, given that the political noise, those noise-canceling headphones just aren't working.
Could really feel it in the last couple of days. We're lower this morning on yield by 2 basis points, about 443. Equities near session lows, we're down about 0.4%. Let's get you some morning calls. First up, Guggenheim cutting its price target on McDonald's to 280. The analyst removing the chain's best idea designation, but noting long-term structural advantages. Next up, Stifel raising its price target on Costco to 900. The analyst highlighting the big box chains accelerating grocery share gains over the past 5 years. And finally, Baird maintaining its 280 price target and outperform rating on Tesla. Analyst Ben Callow saying that while delivery numbers still matter, he sees attention shifting ahead to the August 8th robo-taxi unveiling. That stock is down this morning by 1.6%. And Ben joins us now. Ben, let's get to it. We'll separate those two stories. We'll start with deliveries and then we can talk about August 8th. What are you expecting today on the delivery side of things?
Hey, good morning. Thanks for having me on, as always. So we're expecting 435,000 deliveries. The street's just slightly above us. I think deliveries are expected to be weak. So if they get close to our numbers, I think the stock reacts very positively because everyone's looking ahead. First to that robo-taxi event in August 8th, and really into next year with the next generation vehicle platform coming online.
You can tell that because it's in the price band, because if we were looking at a company that had 2 negative quarters of growth, we'd be wondering why it's a growth stock. But it still is, based on what people still expect over the next 12 months or so, Ben, particularly starting with August 8th. So let's go to it. How much of a game changer is August 8th? And when can we expect to actually see this rolled out and delivering top and bottom line growth?
Well, so I think we're going to separate a couple different things. First, robo-taxi, I think that we look at it in 2 different ways. First, does Tesla own their own fleet? We think they do. So they'll put a small number of cars out there. And I think probably as early as next year, sometime next year, and then start rolling it out, the option out to its car owners to use a robo-taxi type application where they could use their cars and rent them out to other people. I think that's more of a longer term type of event. And then at the event, I also think that we probably can get a reveal on the next generation platform, which should include multiple different vehicles. I don't know if they show them all at once, but this is something that the market is looking forward to. So like you said, we've been in a period of volume kind of stagnation. And the next generation platform really gets you back into that growth mode, and we should see that going on into 26, as they've said that they've started ramping up production late this year and into next year.
So shares currently around $208 each. So you're seeing about a 35% upside. I'm just curious about how big the bar is for you, how high the bar is for you on August 8th to really justify that valuation, whether if they don't meet your expectations, you would actually become bearish in the name.
Well, I think that just overall, me included, and investors all over, have fatigue around Musk saying, full self-driving will be here in 1 year. They've been saying that for 5 years. Now, this is a very, very difficult problem to tackle. Many different companies are trying to tackle it. We think Tesla's in the lead on the front here. But I do think that, Musk has learned over the years about timelines. And I think putting this event in August 8th, there's a realistic chance that we see, cars on the road performing, the robo-taxi application within the next 6 to 12 months. And I think that bar is high, but I think that they'll meet that bar.
You know, I have to say, Ben, one aspect that people don't talk about when they say the robotaxi is just what's the kind of lag time to get some of the trials up and running for the regulators to sign off on it. I remember back in Texas when they were having some of the robocars being tested out. I know that GM has had some snafus with their taxis, the robotaxi type of service in San Francisco. How high is the bar just to get it up and running and profitable? And is that important to you?
It is important, and I think that they'll choose their location specifically where they can get cars out to the road the soonest. You know, there's areas in Phoenix, for example, but different states have have different rules around putting self-driving cars on the road. I do think that that's probably the lag time, you know, where I say 6 months from August before they get cars on the road is more from a regulatory perspective than from a technology perspective. We haven't seen it. One key thing that we're looking towards is when Tesla starts taking liability of the full self-driving. Right now, they caveat everything. There's nags on the steering wheel where you have to hold the steering wheel. When they start removing that type of thing, that shows that they're taking some of that liability on, and I think that shows that the technology has evolved to where it's really functional.
Ben, appreciate the update on your view. Looking forward to the numbers later. Ben Keller there of Baird. I say we're looking forward to the numbers, but ultimately what we're hearing from a lot of bulls on the stock is that the numbers don't really matter. What matters is what happens on August 8th and what they're looking for in 2025. As
of right now, the numbers don't look very good. There have been a number of declines when it comes to their sales. Today, it's being reported that their sales in China fell 24% in the latest reporting period. This isn't small. I remember when we used to say that China mattered. It doesn't evidently because robotaxis. So at what point do you have to see something that can deliver profitability in order to, I don't know, continue to feel bullish on this name?
Can I change the subject?
Yeah, please.
I know that you love this story and don't like that one so much. This is from Bernie Sanders, Senator Sanders, and the president. Yeah, sure. Okay, op-ed piece published in USA Today. They want lower prices on Ozempic and Wegovy. This is the quote: "If Novo Nordisk and other pharmaceutical companies refuse to substantially lower prescription drug prices in our country and end their greed, we will do everything within our power to end it for them." Talk about trying to change the subject from Thursday night.
Okay, I do love this story. First of all, Novo Nordisk shares did initially have a 3% drop. They have currently fallen to less than about 1%, so not exactly a massive move. It just is an interesting moment. This is President Biden and Senator Bernie Sanders in an op-ed in the USA Today newspaper in the United States. A question of whether basically saying, if you're on Ozempic and you're paying $1,000 a month, we're going to be there for you. We're going to cut your student loans. We're going to get you free houses. Yeah. It's sort of like, all right, I understand you're basically flooding the zone. At the same time, how much is going to ring true at a time where ultimately it is up to Medicare and Medicaid, and they've been really pushing back pretty dramatically as far as coverage goes. And, how much can you potentially do this, the legality of it? It's just talk about changing the subject.
Yeah, or attempting to. Attempting to, I think, is probably the right way of framing this, because they're not going to be able to change the subject from Thursday night. They can keep trying. They can keep trying, but they're not going to be able to.
What are you talking about? I'm just thinking about Ozempic.
Oh, is that all you're thinking about now?
Well, I'm being somewhat facetious, but this issue is that you just wonder how many things are they going to pull out to try to shift the topic, and at what point they have to actually address the elephant that's standing in the room on the table, just sort of saying, "Hello, here I am."
Yeah, it's not going away. You have to keep remembering why we did that debate at the end of June. Because this campaign...
We're hearing mixed reports. I've been reading a lot about this. How much do donors say, all right, can we try to shift this a little bit?
Hard to know who to trust now. Honestly, I think that's the way a lot of people feel in this country.
And how they pass his war chest of money on to somebody other than Kamala Harris, which is a big problem as well for them.
Yeah, we're looking ahead to economic data, so we'll focus on that. We'll catch up with Dean Mackey of Point 72 and BMO's Ian Lingen up next.
your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Let's get you set up for the next 60 minutes or so. So we have got Chairman Powell speaking in about an hour from now, 60 minutes away, around the opening bell in New York City. Chairman Powell will be in Sintra, Portugal, delivering an address alongside President Lagarde at the ECB's forum. Looking ahead to all of that, your equity market right now is negative by about 0.4%. We're pulling back by 0.5% on the Nasdaq 100, just taking away some of yesterday's gains. In the bond market, taking back some of yesterday's sell-off. In treasuries right now, yields just a little bit lower by 2 basis points, 443.75. And Lisa, we've been asking a question, others too. What would stem this sell-off of the last couple of days?
And maybe it's just levels. I mean, we heard from Matt Miskin over at John Hancock that it's a buying opportunity just simply because it's high yields and you've got to ignore the noise. Question is, especially as it gets noisier and noisier, a lot of us don't have noise-canceling headphones that can really select what you should be paying attention to or not. November looms large. Expect more of this, and we've heard that from a lot of people.
Yeah, you can't cancel it out, which is why the movement at the long end's been noisy, but the front end's been quiet. And I want to talk about that just briefly, why the front end has been so quiet, given these conversations that we're having.
Partly because the Fed basically said that they're not going to raise rates, period, full stop. The issue now is just how quickly the economy is weakening. Really interesting, and you've been raising this over at the ECB, where there's been sort of a similar trend. Are they going to be the leaders in terms of cutting rates once and then not cutting again? And what we heard from Philip Lane over at the ECB during the Sintra conference is essentially there is a fundamental question on services, and it's a global question. At what point do you see true disinflation in that area akin to what these central bankers need to see?
Based on what we've heard from the core of the ECB executive board, from the chief economist, from the ECB president, July ain't happening at the ECB, based on current communication. Let's check out the euro. It's weaker today by about 0.1%. I can tell you the dollar is stronger against everything in G10 with the exception of the British pound and the Canadian dollar. If you want to look at dollar yen, which has shown just a little bit of weakness too, we got close to 162 earlier, 161.56. Don't know how many times we have to say this. The verbal intervention is not working in Japan.
Vanguard is saying that it could get to 170, which would be a new record if post-1986 if the Bank of Japan does not raise rates at the July meeting, at this month's meeting. And this is really the key question. How will there be a response at a time where some people are saying that the authorities aren't that alarmed? I will say that they do get a lot of tourism. I don't know if people like that or not in Japan, but I've heard first from secondhand that it's actually quite a good time to visit.
I think the tourists like it, that's for sure.
Yeah.
Much weaker Japanese yen. Let's get you some top stories. Under surveillance this morning, sources telling Bloomberg the Democratic National Committee is considering formally nominating President Biden as early as July 21. The party had already planned to nominate Biden before their August convention. There's conversation now that accelerating this is a big benefit because we can put to bed this idea that we're going to change the top of the ticket.
What's interesting to me, and it's something that a lot of different political commentators have said, is that Joe Biden questions around his with-itness, I'll just say.
Is that what we called it?
Yeah, I mean, I don't really know what else to call it, have been percolating and baked into the polls for quite a while. And if that's the case, there are going to be people in the Biden camp who say he still has a chance to win, especially people who are close to him who will remain in power should he be reelected. Ultimately, that seems to be part of what's behind some of the reluctance to basically give in to a host of pressure to maybe pave the way for somebody else.
Compare and contrast that to what we're hearing from market participants and the way they've been seeing developments in the bond market. They see things very differently. That Thursday night was this major game changer. And we said on this program yesterday, Friday felt like the first trading day of this campaign in 2024. It was like the first day where you felt like people weren't just thinking about trades, they were starting to express them.
Partly because it raised this question of a sweep. Who's going to come out during the election? How do you get turnout at a time where there isn't necessarily enthusiasm for either candidate? How do you raise that enthusiasm down ballot? And that, I think, is really the key question for a lot of people to understand what policies get through.
Yields have been climbing over the last couple of days. This morning, at least, they're pulling back by a couple of basis points. Across the curve, on a 2-year, we're down 2. On the 10-year, we're down 2 or 3 basis points. Another story for you. Barry Diller is considering an offer for Paramount. The New York Times reporting that Diller has signed NDAs with its parent company, National Amusements. Paramount has attracted other suitors, including David Ellison, Skydance Media, and executive Edgar Bronfman Jr. So this has been going on for a while. This stock is up by 3-4%. You were tired of talking about Tesla and deliveries a little bit later. How tired are you of talking about this?
I'm waiting for the special to come out on Netflix about Paramount's purchase plan.
This has been going on forever.
I know. I just kind of feel like at a certain point, how many, different media moguls can get sort of trumped out there to try to buy into this area? At what point is it not a vanity project? Does it become something that could potentially be, highly profitable and consolidate some of the media that we all absorb?
Well, here's another name for you. All right, let's talk about something Lisa's actually interested in. Investors keeping their eyes on this week's long list of potential catalysts, starting with remarks from Fed Chair Jay Powell at 9:30 Eastern. That's just ahead of jobs data at 10 o'clock, followed by jobless claims tomorrow. Honestly, there's so much data tomorrow. ADP, ISM, take your pick. Then on Friday, we've got the payrolls report. Mike McKee's with us around the table. Mike, let's get to, say, 9:30, 10 o'clock. What are you looking for?
Well, we're looking for Jay Powell probably not to break a whole lot of ground today because there's still data to come. He's speaking a lot this month, so he'll have other opportunities, including week after next when he goes up to Capitol Hill. So he's probably going to keep it fairly generic and stick to the idea that we have more work to do and we'll make our decisions as the data comes in. At 10 o'clock, the JOLTS number is going to be interesting because it has been something the Fed has focused on, the fact that the labor market was very tight and now it's loosening up. And I've got a chart here that shows what most of the analyst notes I've been getting are focused on, and that's the JOLTS ratio, the ratio of job openings to the number of unemployed people. And you can see how the unemployment rate goes down when the number of job openings is up. This is very logical. That's basically the Beveridge curve. But you can see the number of job openings is just about at the level it was before the pandemic. People are saying that will signal, if we get another drop, that will signal that we have finally gotten to the point where the labor market is loosening up.
Does that really give an indication for the Federal Reserve at a time when, I remember when people used to say that JOLTS was difficult to really get too much conviction from, and then the Fed leaned entirely on that to make one of their moves. Are we going back to that kind of point?
It's not going to be that the Fed's leaning entirely on it, no, but it's going to be a data point. It's going to suggest that what they see in other labor market data is probably correct, and by that now we're talking Friday and the jobs report and the unemployment level and whether that continues to rise or not.
We've seen a lot of concern about ongoing inflation in services, and there's a lot less concern, obviously, about goods in terms of disinflation there. Is that the reason why nobody seemed to really mention yesterday's ISM manufacturing data, that everyone's looking ahead to other metrics? I mean, does it sort of make sense to you that there's certain things that just don't suck up a lot of the oxygen in the room?
Well, there's a lot of things sucking up oxygen in the room, and I suspect yesterday's Supreme Court decision did a lot of that. We did see, because of the ISM number, that the Atlanta Fed lowered its GDP now forecast for the quarter to 1.7%. Remember, a week ago we were above 3%. Now, that'll change as we continue to go forward into the month of July and we get more data. Markets are probably going to focus more on the idea, and I heard you say this earlier, how fast is the economy slowing down? We know it's slowing down. How fast is the economy slowing down, and is it at a point where the Fed would need to start thinking about taking action to present a problem? And in that case, they're looking to the jobs report, and they're looking to the unemployment numbers to give them a sense of how fast things are going.
This started with Yelena Shuletseva of BNP just yesterday. Seems to be a bigger focus on the jobless rate than the actual jobs number on Friday.
I'm sympathetic to the idea that we can't really understand the headline figure because the actual labor force has increased so much. So wouldn't it make sense that you would need a greater number of jobs getting created every single month to just stay stable? It's sort of like inflation, right? The price is different. I mean, it's essentially, if the population is inflated, the number has to change.
Well, it's been this argument that immigration has raised the number of people who are available to go to work, the labor force. But immigration has dropped off a lot in the last couple of months, and so we're sort of expecting that to go backwards. Friday, I think we're going to see a lot of people bringing up the Psalm rule. You had Claudia on this morning, and it's funny, she said she's not paying as much attention to it right now because of the reason you were talking about, the fact that the denominator rises significantly. But if you look at the Psalm rule in the past, it has always basically predicted recession, or that you're in a recession, and we're very close right now. You need a half basis point move. We're at 0.37, so it would only take unemployment going up to around 4.2% on Friday, which is certainly a possibility for us to trigger that. Now, Claudia says it may not be accurate, but just try to tell Wall Street people. That's why I say creeping closer to a freak out. They're gonna, if you get that 5%, you're gonna have a lot of doom messages coming in.
It is pretty funny that the one person who's not focused on the Psalm rule is Claudia Psalm herself. Mike McKee, thank you, sir. Let's continue this conversation and get to the panel. Joining us now is Point 72's Dean Mackey, alongside BMO's Ian Lingen. Gents, it's great to catch up with you both. Ian, I'm going to come to you first. What is more important to this bond market right now? The economic data that we get this week, or the debate that took place Thursday evening?
Well, over the course of the last two trading sessions, it has undoubtedly been the political tides in Washington and what it means for November. That being said, we have payrolls on Friday, but perhaps more importantly, next week we get CPI again, and that will give the market some very good context for whether or not we'll see that September rate cut. That's the active debate that matters at the moment.
Ian, there's still some banks out there suggesting that maybe payrolls this Friday is more important than CPI next week. Would you take the other side of that?
I would take the other side of it in a consensus print. But if there's a surprise, if you get a 4.2 unemployment rate or a sub 100,000 rate for headline payrolls, then all of a sudden the dual mandate employment aspect becomes a lot more relevant than CPI.
Dean, how are you thinking about that trade-off? If unemployment continues to creep higher this Friday, does it take some weight away from the importance of CPI next Thursday?
I think at this point, the Fed really is focused on inflation. The Fed needs to see inflation heading back toward the 2% target. And if that's the case, then we can have a strong payroll report and the Fed will still think about cutting. So I think the Fed's focus really is on the CPI next week.
Dean, how do you understand what some of the data has been saying in terms of slowing but not slow? There is this feeling right now, especially as you look more to the inflation print than you do the labor market, there has been this feeling that we're on the precipice of something that could be more punitive for the U.S. economy. Do you agree? And if not, why not?
I don't agree. I think there's been some mixed shifts within the data that makes some of the data look weaker than it really is. So, for example, consumers are shifting away from spending on goods and food services and towards other categories. But those other categories are not included in retail sales. So retail sales looks weaker than overall consumer spending, but markets tend to focus only on the retail sales report. So that's part of what's happening, is that consumers are shifting toward pre-COVID norms, and that's not showing up in some of the data that people are focused on.
Do you agree, Ian?
So I would say that, generally speaking, on the consumption side, I agree. But I am a bit more concerned as it pertains to what's going on in the employment landscape. We do have higher claims. We have the JOLTS quit rate at 2.2%. And there are signs that the Fed has been effective in reintroducing balance to the labor market. But my concern is whether or not the pendulum swings too far in the side of, or toward the side of cooling, and then that starts to perpetuate on itself, and it's difficult for the Fed to address that without some type of policy response.
This is the worry that Claudia Psalm has as well. We had her on the program with us a little bit earlier this morning. We quoted her before we went into some of her work. I just want to share this quote with you, gentlemen. A good labour market is not a reason to wait. The reason to cut is that inflation is down considerably. A good labour market is what it's at risk if the Fed doesn't move. Dean, how do you think about that framing going into the July meeting at the end of this month, and ultimately when Chairman Powell speaks in about 45 minutes?
I guess I'm a little less worried about the labor market at this point than some people are. And one reason is that corporate profits corporate profit margins are close to the highest level since the 1960s. And corporations are not inclined to do massive layoffs with profitability that strong. You know, payroll growth over the last 3 months is 250,000 per month. Jobless claims are in the 230s. This still looks like a pretty good labor market to me. What I think has happened is the labor market has normalized rather than weakened sharply.
Ian, this has big implications, consequences for the shape of the yield curve. We came into 2024, we were looking for steepness, but we thought it would be driven by a rate cutting cycle, fueling a rally at the front end of the curve. Can you just put some meat on the bones of this bear steepener of the last couple of days, Ian? How sustainable you think this move actually is? A disinverting yield curve driven by the long end?
So I think that we all know the story. It has to do with the potential of Trump regaining the White House and some of the forward inflationary implications of that. That steepened out the curve. Deficit spending implies greater issuance. So that's why we had a bear steepener. Now transitioning this to a bull steepener, I think will require at least an initial bear flattening impulse as the economic data starts to deteriorate. But eventually, what we'll see is when it becomes abundantly clear that the Fed is about to start normalizing yields or policy rates lower, 2-year yields will drop and they'll price in an extended cycle back to some version of neutral. And so we could easily see a 50, 60 basis point rally in the 2-year sector once the process starts, and that should re-steepen the yield curve and put the benchmark 2s10s curve back into positive territory.
So Ian, do you kind of agree with John Stoltzfus that this is essentially the bond market looking for attention from the Fed?
To a large extent, the bond market is tightening for the Fed at a moment where the Fed is considering dialing it back. So I do think that to some extent, this is a reminder that flows and supply and demand do matter in the Treasury market, but only within the context of the prevailing range. Keep in mind, 10-year yields are still below 450. And this in an environment where the real economy still appears to be on strong footing, at least for the time being.
Dean, you've been in the market for decades trying to analyze the economics of the moment. I would love your insight into how realistic we can be about some of the potential scenarios that are being priced into the bond market, with really Thursday night being thought of as a watershed moment, really looking for the potential for a Republican sweep and the idea of some of the fiscal policies, as well as tariffs, et cetera, put into place. Is that something that you are gaming out actively and think is a bettable type of option?
I think we always want to be thinking about all of the various scenarios, and markets will try to price in what might happen. But ultimately, from my experience, markets don't really fully price things in until the market is pretty sure it's going to happen. So we might see the scenario shift back and forth multiple times in the next several months before it finally settles on what truly is going to happen.
Hey, gents, this was great. Dean Mackey of Point 72, Ian Ligon of BMO, going into Chairman Powell at 9:30 Eastern before we get that first sniff, that scent of the jobs data this week when we get the job openings at 10 a.m. Eastern time. Equities right now on the screen, negative by 0.4% on the S&P 500, about 43 minutes away from the opening bell. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John, you'd mentioned this. President Biden is teaming up with Senator Bernie Sanders in a joint op-ed in USA Today. The two are taking on drug prices, writing this. Let's be clear, it's not just Congress that needs to act. Prescription drug companies also must stop ripping off the American people. Drug makers Novo Nordisk and Eli Lilly are called out by name. The letter also goes on to say that the Biden administration is working on legislation to expand Medicare's negotiations on drug prices. A check on Rivian shares pre-market for you. They're up 1.2%. The EV maker reported second quarter deliveries just above estimates, while it also reaffirmed its guidance for annual production of 57,000 vehicles. Analysts are now waiting deliveries from Tesla due this morning. Bloomberg estimates that the company delivered 440,000 or thereabouts vehicles in the second quarter. That's a drop of 5.8% from a year ago. And the U.S. men's national soccer team has had an earlier than expected exit in the Copa America, failing to qualify for the knockout rounds after a 1-0 loss to Uruguay. The tournament hosts entered last night's match tied on points with Panama in Group C, but their loss, coupled with Panama's 3-1 win over Bolivia, saw the U.S. knocked out. The tournament continues tonight with Brazil meeting Colombia at 9 p.m. Eastern. And that's your brief, John.
Danny, thank you. Thanks for this morning. If I ask you both, How many people in this country do you think know that that is being hosted in this country right now? That some of the best football players on the planet are in the United States?
I would say I'm biased, and I am not able to answer that because I am surrounded by people who might have other interests.
I don't think that they've done a very good job.
No, it hasn't
really
been
marketing this
publicized.
at all, right?
People who know football, soccer, know, but the average American.
I've heard more about the cricket in the last few weeks than I have this.
Okay, but I come on this set every day and hear about plans to get tickets to these games. So I'm just saying, I am definitely a biased.
We got to broadcast
commentator.
live with her.
Yes,
yes. When the World Cup.
I'd like to think it's going to be a better effort in 2 years.
Yeah,
Let's put it that
I
way,
hope so.
for 26, for the World Cup. Up next on this programme, we'll set you up for the day ahead as we count you down to the opening bell, about 41 minutes away. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
This is Bloomberg.
Equities right now on the S&P 500, negative by 0.5%, counting you down to the opening bell. Here's the trading diary for the week ahead. Fed Chair Jay Powell speaking at 9:30 Eastern from Sintra, Portugal. Jobs, job openings data coming at 10 a.m. on a Wednesday. Absolutely stacked because we closed on Thursday. We'll get jobless claims, ADP, ISM services, all of the above. Then on Thursday, of course, we close, but there is a UK election taking place. This week's so busy. On Friday, the big one, payrolls. Lisa mentioned the median estimate in our survey, 200K. Looking ahead to the payrolls report on Friday. With us around the table, I'm really pleased to say, is David Rubenstein of the Carlyle Group and host of Bloomberg Wealth. His latest interview is with Josh Friedman of Canyon Partners. You can watch that on Bloomberg TV at 9 p.m. Eastern Time. David, good morning to you. Looking forward to this one. What do we need to know about Josh?
Josh Friedman was a poor boy, or I wouldn't say poor boy, middle-class upbringing, Boston, went to Harvard, Harvard College, Harvard Business School, Harvard Law School, top of his class every place, Marshall Scholar, degree from Oxford. And then he went to Goldman Sachs with that kind of pedigree. You're not surprised, perhaps. He then went to a place that wasn't as well known as Goldman, then Drexel. And at Drexel, he was there and very, very smart person, but then Drexel imploded. And so when Drexel imploded, he started his own firm with a very, very smart person, but then Drexel imploded. And so when Drexel imploded, he started his own firm with his Harvard Law School roommate, and they built it into a gigantic credit shop called Canyon Partners, which has done it very well. It managed about $26 billion now. A Japanese bank just bought a big stake in it, a Japanese insurance company, and they're in very good shape. They've given spectacular returns to their investors over many years in credit, principally. And he's a very, very smart person, and I had a chance to spend some time with him recently, and I can see why he's done so well. Very, very analytical, very smart, knows the credit business quite well.
It's going to be wonderful to watch. I will be watching, and I can't wait to see it. I'm going to shamelessly switch the topic just slightly, because we've been talking about the Celtics, and we've been talking about how the value is quite high, and the owners are selling it. We don't have Steve on the show, Steve Pagliuca, to really respond to this, but we wanted to ask you, is it sort of peak valuation? Is it time to sell some of these teams?
Well, they've owned that team since 2002, so it's been more than 2 decades, so not surprising to sell after 2 decades. Clearly, they paid a much lower price. I think they paid low $300, mid $300 million for it. Today, I suspect the team is worth $4 to $5 billion, maybe more than that, maybe $5.5 billion. New teams that are going to come into the NBA with no players are probably going to go for $4 to $5 billion. So a team that already has a championship quality team, there probably will go more than $5 billion, I guess. So it's going to be a good payday for those investors. There are many investors who went into it. So after 2 decades, I don't think you can fault somebody for willing to sell their team.
Well, I guess the question is, would you be willing to buy into some of the major league, not just baseball, I know that you did, but some of the valuations that you see out there currently being floated?
I would rather buy at a lower valuation than some of these prices that people are offering today. But, you know, I did pay a fair bit of money for a baseball team. When the Orioles came to Baltimore in 1954, the purchase price was $2.2 million. And we paid, you know, over $1.6 billion. So prices do go up. And there's no evidence of anybody buying sports teams in recent decades losing money on it.
David, this was great. And I will say, just to promote the program again, looking forward to David's interview with Josh Friedman of Canyon Partners, Bloomberg TV, 9 p.m. Eastern tonight. Do not miss this a little bit later on. Tomorrow on this program, just a promo for you, James Athey of Marlborough Investment Management will be joining us, Kit Jukes of SocGen, Jordan Jackson of JP Morgan Asset Management, Mark McCormick of TD Bank, with lots of questions about the election and what it means for this bond market, particularly the bear steepener we've seen in the yield curve over the previous 2 days.
Can I just say, especially after talking to David Rubenstein, it sounds a lot more fun to dance at an Orioles game as the Orioles are in first place than betting on the macro trends in the market right now. That's all I can say. Is that sounds like a lot more fun.
Change your career? Is that what you're asking for?
I think I want to invest in it, some sort of professional sports.
We can have a little chat with David in just a moment.
I think I will.
All right. From New York City, the opening bell, about 35 minutes away.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the Quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
From New York City, for our viewers worldwide, I'm Matt Miller. We are waiting for some important Tesla numbers. Markets are down right now. The countdown to the open starts right now. Futures losing steam as investors await Friday's jobs numbers. We'll see those from the beach. Central bank leaders try to manage the message at a gathering in Sintra, Portugal, and Tesla deliveries expected to slump yet again amid a price war in China. But we begin with the big issue, concerns shifting from inflation to the labor market.
In the Fed's dual mandate, we've been doing great on the employment side, and we have done far less great on the inflation side. But now inflation is coming down, so we got to think about both sides. Usually, as they describe, unemployment goes up like a rocket and comes down like a feather. And so that's on everyone's mind, that there are some warning signs in the job market. The job market is still quite strong. It's just been some warning signs.
Joining me around the table now, Brian Levitt, Invesco Global Market Strategist, and Amy Wu Silverman, RBC Capital Markets Head of Derivatives Strategy. And there is a lot to talk about. It's not a slow summer. It's not a slow holiday week. Let's talk first about the Fed. We're going to hear from Jay Powell with Christine Lagarde in just a moment out of Sintra. Brian, what do you think about the Fed's job so far and where we're headed?
So the Fed has done a good job so far, but they're at risk of getting behind, where they're very data dependent. I want them to be looking forward. And I agree with what Austin Goolsbee was saying, and it's comforting to hear Austin Goolsbee say, I think the inflation story is passé. Right? If you look at the core personal consumption expenditure, we're in the Fed's comfort zone, right? And yet 5.25 to 5.5 target Fed funds rate is too tight for a 2.6, 2.7% inflation world. He's right. The job market is starting to slow. Let's get on with the process. Let's get out in front of the economic slowdown and start easing policy.
Right. He's pointing out that, you know, as inflation comes down, holding pat on rates is actually like tightening, which makes a lot of sense. Amy, what are you seeing around the Fed? What kind of bets are investors placing?
Look, people are busy placing bets, but they're all through zero-date expiry options. They're quite busy doing that. If you look at the volumes, they're quite historic. But overall sentiment, look, in the volatility world is still pretty sanguine. You still have a 13 handle on the VIX, 7 points below our 30-year average, which would tell you that sentiment is still not there in terms of worry. But I do think things are shifting a little bit.
All right, we have got breaking news on Tesla. Second quarter deliveries are out at 443,956. That's a little bit better than the estimate, which was for 439,302. It's still a drop, but we are seeing Tesla come out with deliveries that are lower, and we're going to talk about that in just a little bit. We're going to go out to San Francisco, talk to Ed Ludlow, host of Bloomberg Technology, about this. So keep an eye on Tesla in the pre-market, and of course we'll watch to see. It wasn't unexpected, right? We were looking for a more than 5% drop. So we do see Tesla out with second quarter deliveries a little bit better than the estimate, and in the pre-market, those shares are up a little bit. Let's get to the economic data that we're expecting out in less than an hour. It is the JOLTS numbers. Michael McKee, Bloomberg's chief economics and policy correspondent, is standing by. So Mike, what are we expecting?
Well, you know, Matt, the story is sort of, as Austin Goolsbee outlined it, a question of how fast is the labor market slowing. We got one clue coming up at 10 o'clock with the JOLTS numbers, the job opening and labor turnover. How many job openings are out there? We've had an extended high level of job openings, and when that happens, of course, the unemployment rate is low. Now unemployment's starting to go up, and job openings are starting to come down. And the question is, if we get the number forecast, about 7,950,000, do we then see us get back to the level we were at before the pandemic? And if that's the case, the Fed will know that things are going okay because they've been focused on JOLTS as a way of telling how tight the labor market is. This would suggest at least some loosening. Then we go to Friday and the jobs report. Now, the real question is not the total number of jobs created, which, by the way, in the last 30 minutes dropped to 198,000, so I'm not exactly correct with the chart, but the unemployment rate, 4%. Does that continue to rise? It rose a little more than expected last month, and now we're waiting to see if that continues because, of course, there's something called the SOM rule. The SOM rule posits that 3-month moving average of unemployment, when it rises a half percentage point over the 3-month average low of the past year, you are in recession. We're getting close. You can see down there in the lower right-hand corner, very close to that level. And as you can see from the chart, every time we hit that level before, we went into recession or we're in recession. Now, Claudia Sahm thinks herself, she was on Bloomberg TV this morning, that maybe it's not that bad because we are seeing a big jump in the labor force with immigration, but immigration has tailed off. So do we start to see real problems with unemployment, and does that force the Fed to move? Those are the questions Austin Goolsbee is asking, and those are the questions some of this data will help answer.
All right, Mike, thanks very much. Michael McKee there talking to us about the JOLTS number that we're going to expect and how the Fed views things. Amy Wu Silverman here from RBC. And, you know, it's interesting. Mickey Bowman, I think last week, was talking about the fact that we're seeing some restriction on immigration. The Biden administration trying at the very end of the term, right before the election, of course, and Trump, if he wins, is expected to be very restrictive. Does that tighten supply, do you think, on the labor market? Do you see people putting bets around that?
It's a great question, and it's funny because I will tell you, up until now, up until the presidential debate, we haven't really seen that many bets in the options market. That really is starting to change, and it's not just because, you know, the predicted bets are really overwhelmingly swinging one way. I think people are basically asking me where the shocks to the volatility have been in history and where we can go in the future. And, you know, I can tell you that VIX can go to 35. It can go to 40 from the 13 hand levels. So people are looking at VIX calls. People are looking at downside. And it is very election related because of the policies that Trump has talked about. And obviously, post the presidential debate, the betting market's essentially saying that he has a higher probability of winning.
That's really what I was clumsily trying to get at, is that there's a lot of volatility around these elections, right? I mean, some people come on and say, especially, you know, equity strategists, it doesn't matter. On the other hand, you've got some pretty dramatic results out of France. You have the election coming up in the UK, and here in the US, I think maybe opinions change quickly after people watch that debate. Brian, what do you think about the importance of the election? Does it matter to this rally, for example, that we've seen in stocks?
I don't think it matters to this particular rally. I think the Federal Reserve is far more important to this. The thing that I try and do, and it's my job to try and help ease investors' concerns around the country, at least keep them sticking to a plan. And every 4 years, years, election concerns come up. And some of the things, Matt, that I've been trying to tell them is, look, people were very worried when Trump won in 2016. The market was up 60% under Trump. People were very worried when Biden won in 2020, probably the opposite people. And the market's up 71% under Biden. It was up 200% under Reagan, 200% under Obama. So it doesn't matter in the broad, in the aggregate as much as people think. Since 1957, there's only been 2 times where a presidential administration ended with negative returns in the market, and that was Richard Nixon, whose term didn't finish, and George W. Bush, whose term ended in a great recession. So I do think it's overplayed from the perspective of investors watching us today. Don't allow this to freak you out of your positioning. The markets have done well historically under all parties, most presidents.
But you can trade around it. Certainly in the options market, you can trade around elections, right? Amy, you can trade around new debt numbers and deficits that are just seemingly out of control, even though strategists will say it doesn't really matter right now. I talked to Ed Hyman, and he says, if the 10-year doesn't care and if the dollar doesn't care, I don't really care that much. But what does the options market say?
Look, all it comes down to me is tenor. So it's really quite simple. I actually agree with Brian on a longer term basis. That is true, but the actual nuance, I think, to the volatility markets is if there isn't clarity about who the winner is. And I think that is a tail concern that seemed very, very low probability, but now is a little bit more high probability now. And the issue is when it's not clear who the presumptive candidates are, then you do get volatility. You get for instance, a year 2000 where it wasn't clear, your VIX spiked dramatically. And again, it comes down to tenor. Do I agree that on a 1 to 5 year basis, this is something we can look through? Sure. A lot of the investors we speak to, they're more 1 week to 3 months. And that tenor difference, I think, is where you start to trade around that. And we do see folks doing that because it is less clear now than it was before who the presumptive candidates are.
And I agree with that. What's interesting, though, and it's hard to figure, when you look at any time that volatility has spiked during election periods, it's been associated with a recession, whether it is 2000 or whether it is 2008. If you look at most other election periods, volatility has not increased. If they're not associated with recessions, then they don't increase. But I do agree policy uncertainty creates volatility. That's where it always comes from. And I'm more concerned about policy uncertainty with the Federal Reserve at this moment. I mean, to me, we probably know who the candidates are. I think that's our base case. And if we don't, I can't imagine significant changes from the policy platform perspective.
I mean, both of you, I think long-term would agree that it's about the earnings. It's about the economy, right? And I mean, that's why the Fed is important. If you take a look at the Atlanta Fed GDP now picture, it doesn't look very bright, right? They predict a continued drop in GDP growth, even though we've had this earnings expansion. It's been driven mostly by the Magnificent Seven, right? The 493 haven't caught up yet.
Right.
Do you expect that to change?
Well, we would need a catalyst for that to change. And so, the catalyst would need to come from a shift in the policy environment. We need to normalize the yield curve and work to reinvigorate economic activity now that we're clearly slowing. And so, if you look at signs, are we heading into a recession? Do we have corporate bond spreads blowing out? Do we have bankers tightening lending standards? No. But tactically, it's an economy that's slowing, and the longer we sit here with tight policy and an inverted yield curve, the higher probability we get of a policy mistake. I'm not there yet, but I would like to see the Fed move. They just don't answer my phone calls.
Well, maybe they'll listen to this program. Amy, what do you think of the market? It's so sanguine, right? As you mentioned a few times, the VIX is so low. We can climb on the S&P with no breath at all. I mean, I've seen a couple of days this year already with 112, 113 winners, and yet we're up. Only 10 companies make up 35% of the total index and 23% of earnings. Does this lack of breadth look worrisome?
It is actually very worrisome to our investor base, and it sort of just comes down to the math. So I'll give a simple example. The days where you see small cap do well or you see breadth widen, the overall market is actually down. because it's actually more of a function of the weight of the heavy mega caps. And so what we're actually seeing investors be selective about is saying, okay, I'm going to hedge, but I'm just going to use the Mag 7 as my hedge, because essentially it's a proxy to the overall market anyway. And we're at a period where implied and realized correlation has just never been this sustainably low. And what happens when correlation picks up? Volatility rises, the market goes down. And to me, it's if tech goes, the market goes. We watch sentiment on those 7 names unbelievably closely, and those have not been that great. People want to hedge those names. People are more looking for protection on those names than they were, say, 3 months ago.
When is it time to rotate out of the, like, when do you take profits from the money you've made on NVIDIA and say, I'm putting it all on the Russell 2000?
And the interesting thing is right now we're slowing, and slowing means you tend to want to be in the more mega cap, high quality
It's kind of defensive.
names. Yeah, it's sort of like a heads we win, tails we win right now with the mega. So I hate to keep putting it on the Fed or the shift in the environment, but you would need the catalyst for that. Usually, I mean, we saw it, Matt, right, in November and December of last year. The market priced in 6 rate cuts, and yet a bull market in small caps in a couple of days, not a couple of days, but you know what I mean. And so you see what that can look like, and we've spent this year pricing out the rate cuts. So we've gone back to the mega high quality because the market thought Fed was too tight and we're going to slow down here, which of course is happening. So, you know, you'll need the catalyst, the next shift in policy, hopefully without a recession. But even if it is a recession, the recovery out of that will be more cyclical, more small, more value-oriented. So, you know, hopefully we recover from a slowdown. If not a recession, either one of those will likely broaden out the markets.
All right, thanks to both of you for joining us. Amy Wu Silverman of RBC Capital Markets, Brian Levitt of Invesco. We're going to take a look right now at some of the individual stocks moving ahead of the opening bell. Just 15 minutes to go. For that, we go over to Abigail Doolittle. Abby, what do you have?
Lots of interesting stories and moves for stocks this morning, Matt. Let's start off with the shares of Tesla, because they're at more than 4% on that delivery for the second quarter number, coming in better than expected. Close to 440,000 EVs were delivered relative to the estimate of closer to 439,000. The sentiment has been so low for Tesla. The shares really outperforming over the last 2 days, up about 10% if this gain holds. Technically, the chart is now setting up for a big move higher toward last year's highs. On the other hand, NVIDIA is doing exactly the opposite, is down more than 1% in the pre-market. That chart setting up for a big breakdown to the downside, potentially to go sub 100 if below about 118, and that simply represents buyers who bought well or below 100 on a split adjusted basis, wanting to take profits over time so as to not adjust their profit base. GameStop down 1.4%. That lawsuit we were talking about yesterday, there was an investor who sued Keith Gill for the fraud, the Roaring Kitty fraud suit, basically saying that he committed securities fraud of some sort in terms of his quote-unquote pump and dump GameStop scheme. That has now been dropped. It's really interesting, Matt, because the spirit of the law maybe was stretched there, but it was clear that no law was broken by posting memes on social media. It almost seems as though there was some sort of desire to create a bad sense around Keith Gill. And then finally, Paramount up 3.5%. Barry Diller perhaps entering into the race to explore a bid for Paramount. Yet another story there. This keeps on giving.
All right, so the allegation of frauds rescinded there. Very interesting stuff. Abigail Doolittle with a little technical analysis as well. We got to get those charts, Abby. Coming up, Tesla deliveries beat expectations. We'll take a look at the EV giant next. It's selling all 3s and Ys. No X's and S's. This is Bloomberg.
We invest in, buy, and own
the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Tesla's second quarter deliveries came in above expectations. The EV giant revealing the numbers just moments ago. Joining us now is Bloomberg Technology co-host Ed Ludlow out of San Francisco. So Ed, beating by what, 3, 4, 5,000 in terms of deliveries. What's the story?
Yeah, it's a beat and some relief in the stock relative to street expectations. It's important to note that even though deliveries beat, it's still a decline year on year of about 5%, I think 4.8%. And you could also look at the production level being markedly lower than in the same quarter a year ago. What I find really interesting, Matt, is that I was in New York City for the first quarter numbers, you might remember, where the release had so much detail about the factors that were impacting Tesla in the first 3 months of the year. But in this release for the second 3-month period, there is no commentary at all, which is interesting. You know, it's a considered omission. But we did hear quite a lot from Elon Musk on the last earnings call, of course, about the factors that are impacting both demand but also operationally and supply right now.
I haven't, looked into the detail in a long time, Ed. And of course, you cover this company very closely. But to me, it was surprising that almost all of the vehicles they sold were Model 3 and Model Y. Do they not even sell the S and the X anymore? I mean, it looks like, what, 20,000 of those more expensive models, and the other 420,000 were 3 and Y?
Yeah, I mean, Elon Musk and other Tesla executives have been honest that they largely still make the S and X for sentimental reasons. It is not a volume product. You know, the plaid version, the rethink that they did in the latest generation, it's an expensive and premium product. And there's equal surprise when those less familiar with Tesla also hear the Model Y is technically the best-selling vehicle model in the world.
In the world. That bears repeating, Ed, because I did not know that, and I look at cars all the time. So is it, I mean, I would expect the Toyota Camry, you know, the Ford F-150, like the Honda Civic. The Model Y outsells all of those other single models.
It does, and those other examples you noted, well, I would say with Model Y is its uniformity across different geographies. It sells well in the United States, China, and in continental Europe as it stands, where, you know, as you know from experience, there's a bias towards smaller form factor vehicles. I'd also say let's look at what's happening in the China market specifically, because we also got data from China's Passenger Car Association, which showed in the month of June, not the full second quarter, but June, a pretty significant drop in output from the Shanghai factory and also deliveries domestically. And so Tesla is not doing so well in China at this moment in time, but those domestic players, NIO, Li Auto, et cetera, they're pushing new records. BYD, of course, did very well. And one of those factors that Elon Musk talked about, apart from domestic competition in China, is this admission that Tesla is now directly competing with hybrids, that consumers, when faced with a choice right now in different markets, are opting for hybrids, which I find is really interesting because we've changed our psychology about EV buying in the market completely from, say, a year ago.
Well, I've always thought hybrids are the way forward. It just gives you more optionality as a driver. In terms of, product, Ed, the Cybertruck, as exciting as it may be, they're not selling that in volume. As you said, the Model S and the Model X are just kept around for sentimental reasons, also not big sellers. So it's all about the 3 and the Y, and they still have had a decline in sales. I mean, sales are down 5% year over year. That's not great for a company that wants to be a growth story. What else do they have in the pipeline?
And also noting, I just reiterate, the production is also, down relatively significantly to the same period a year ago. A lot of the sell-siders, for what it's worth, basically say that the lineup is stale if you strip out Cybertruck, which is still ramping. Model Y is the best-selling product model in the world, but it's now relatively old. There's not been a refresh or a new model. Of course, on August 8th, we will get a glimpse of Robotaxi, and during Investor Day, you see the PowerPoints with yet-to-be-unveiled models under canvas. So there's a belief that new models are coming. My own reporting is that they will take the work they did on a $25,000 EV and apply the R&D, the technology breakthroughs, to refreshing the Model Y and Model 3 in particular, lower spec, maybe single motor variants. But that's the argument that industry analysts make, that Tesla would do well if they introduce more models at a more regular cadence.
All right, Ed, great to get your take on this company. Bloomberg Technology co-host Ed Ludlow. Catch his program coming up at 11. Next here, we're going to give you the morning calls. This is Bloomberg.
This is Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Time now for the morning calls. Look at some of the analyst recommendations on Wall Street this morning. First up, Susquehanna raising its recommendation on PayPal to positive. The analyst is confident the company will make profitable growth a top priority. Next up, Piper Sandler is downgrading CrowdStrike to a neutral. That analyst cites valuation concerns for the security software company. And finally, Citi and Raymond are downgrading Raymond James, downgrading Lennard to hold equivalents. This is Bloomberg.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
This is the countdown to the open. I'm Matt Miller. We are moments away from the start of trading. You can see futures are down on the S&P and the NASDAQ. Small caps are gaining right now as we await the opening bell at the New York Stock Exchange and the NASDAQ market site. We are also expecting Jerome Powell, Fed Chair, to speak at Sintra in just a few minutes, and we're going to take that live for you. He's going to be speaking with a couple of other central bankers as well. Here you see some of the other assets that we're watching. 107.36. Christine Lagarde is going to be one of the other central bankers on the panel with Powell. We really haven't seen the euro move out of this range. I mean, for a couple of sessions, it dropped down to 106 after Macron called a snap election in France. And for a while before that, it was up around 108 and change. But it's really been hovering here with very little movement. The 10-year yield as well holding steady at 442 right now, just off about 3 3/4 basis points. And then NYMEX crude actually continuing its upward march. So now 83.89 a barrel for NYMEX. Let's get a look at some of the other stocks moving at the start of trading. For that, we go right over here to Abigail Doolittle. Abby, what do you have?
Well, we do have lots of stocks on the move here, Matt. Let's start off with the shares of Tesla, because right now they are up over the last 2 days 11%. So a very, very nice rally. That's the best rally going back to the end of April. And today's rally, with the stock up more than 5%, this has to do with better than feared second quarter EV delivery numbers. That estimate, or that number, came in at 440,000 versus the estimate of a little less than 440,000. I think the sentiment was so bad, that's why we have this stock up. And on this, the shares of Tesla are very close to putting in a breakout. There's a long-term downtrend that has capped the shares of Tesla. That may happen again because the daily RSI, or momentum indicator, which is not shown in this chart, it is a little bit peaked out, Matt, but on the other hand, the stock is back above its 200-day moving average, and it seems to me as though there could be some kind of a funding rotation going on within big tech, because on the other hand, we have the shares of NVIDIA down deeply in a correction. In fact, actually close to a bear market today, down 2% for no particular reason. If we take a look at this chart, Matt, I would argue that it has everything to do with people who bought very well below $100 per share on a split adjusted basis, and rather than wanting to disrupt their profit, they're taking their time. And so the sideways trend that we've had since the last quarter, that has gone, let's call it between 100 and the recent high, that is again some of those people who bought very well, taking some profits, but not taking it all at once, so to not disrupt their profit taking, the profit that they could make. But if below 118, Matt, we could see a pretty quick drop back down toward the gap earnings for the last quarter that was reported, and that is closer to, let's call it $90, somewhere above $90.
All right, that's, interesting technical. Look at the technicals there, Abigail. I would go back to the Tesla chart, and the interesting thing to me is the market cap, right? Tesla is a $700 billion company. Ford is worth $50 billion. GM is worth $50 billion. Volkswagen is worth $50 billion. This is a $700 billion company that just posted a 5% drop in sales. How does that make any sense at all?
Well, I think that goes back to the question of whether or not Tesla is a technology company or a car company. So I think that it's probably a blend of both. And I think that that market cap reflects its mega cap tech status, and that they're being given a little bit of a breather for that sales drop. Wall Street's all about estimates. It's about perception. So relative to the second quarter EV numbers, what have you done for me lately? They beat. So I think investors are rewarding the shares for that reason. Plus, it was down so much, as that chart showed, that strong downtrend down this year when the other mega caps are higher. I think that that's another reason that we're seeing a bit of a catch-up trade here.
I like to look at, on the Bloomberg GF, graph fundamentals. I was just looking at it for the car makers and noticing that GM sales are up, Ford sales are up, right? Even though they're only worth, a fraction of Tesla. If I look at that for NVIDIA, the sales is just up and to the right. It's difficult to predict where they're going to go. Okay, a great look at a couple of stocks. Abby, thanks very much. I want to get over to Sintra in Portugal right now. Jerome Powell, Fed chair, is speaking with ECB President Christine Lagarde and the governor of the Brazilian Central Bank. Let's listen in.
It's coming on the back of a period of hikes, which was unprecedented, facing shocks that I tried to describe yesterday over dinner, and followed by a period during which we held rates untouched, and during which we were restrictive enough to actually see our medium-term target reach that 2%, which is our objective. And most recently, we have seen in our round of projections, which are really important, September, December, March, and June, we've seen that 2% target with an oscillation of 0.1 about it at the last quarter of 2025. So it's on that basis, and on the basis of what I'm happy to describe as, the three-leg reaction function and all the underlying data and information that feeds those three legs, that we decided to do a 25 basis points cuts. But in the same breath of air, I also said that it was not a linear process, that it was not a predetermined path that we were embarking upon, but a step that would be followed by further review of data, further understanding of where our three legs reaction function would be. So that's pretty much where we are. And I would simply maybe add that we are very advanced in that disinflationary path, and we are in that sort of slow recovery, which came about during the first quarter, and which we hope will persevere. But all of that is flawed with uncertainties and big question mark about the future.
Sounds like you're setting up the market for a pause now. Is that right?
I'm not setting up anything for anyone. I think that it's for everyone to really look under the skin of the economy and see where it's heading, and appreciating what our reaction function is and how we're likely to decide.
Chair Powell, you have also been on a journey and have been on hold since last July, have not cut rates like the ECB in June. Why not? What are you waiting for?
So let me say that sitting here last year, there was a lot we didn't know, and we didn't know that we were just about to embark on a period of 7 months of much lower inflation readings. We didn't realize that the second half of last year was going to be an extraordinary year from a growth standpoint, and also from the standpoint of the labor market. So things actually worked out in the second half of last year in a remarkable way. Then, as you know, in the first quarter of this year, we continue to have solid growth in the first half, actually, solid growth, and a labor market that's still strong, although we've seen a continued rebalancing in the labor market. And inflation, after pausing in the first quarter, now shows signs of resuming its disinflationary trend. So it's a little bit different journey. So where that leaves us is we've made quite a bit of progress in bringing inflation back down to our target. While the labor market has remained strong and growth has continued, we want that process to continue. I think the last reading and the one before it in inflation, the one before it to a lesser extent, do suggest that we are getting back on a disinflationary path. We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy. That's what we've said, and what we'd like to see is more data like what we've been seeing recently. We'd also like to see the labor market remain strong. We've said that if we saw the labor market unexpectedly weakening, that is also something that could call for a reaction.
How much more confident do you want to be? The PCE number 2.6, that wasn't too bad that we got last week.
That's right. So we're actually on a 12-month basis. We're actually at 2.6, both headline and core for inflation, and that represents really significant progress. I think we peaked at 5.4% in core, and the same thing has happened in headline. We've gone from 7.1 to 2.6. So yes, we've made a lot of progress. We just want to understand that the levels that we're seeing are a true reading on what is actually happening with underlying inflation. And as we were saying at the last part of last year, people were saying, you need to declare victory, this is over. And then we had a quarter of inflation which was well above 3%. So we want to be more confident, and frankly, because the U.S. economy is strong and the labor market is strong, we have the ability to take our time and get this right, and that's what we're planning to do.
So September?
I'm not going to be landing on any specific dates here today. Let me also say that we're well aware that if we go too soon, that we could undo the good work we've done in bringing down inflation, and if we go too late, we could unnecessarily undermine the recession, the recovery, and the expansion. And so we're aware that we have two-sided risks now, more so than we did a year ago. That's a big change. I'd say risks are coming much more into balance now.
President Campos, you have been on a different journey because you've actually been cutting rates for much of the last year and have recently paused. Why? What are you seeing in inflation data, and what are you going to do next?
Okay, so if you go back a little bit in the history of time, so Brazil was one of the first countries to hike rates. I think in part because we had a different call on the dynamics of inflation, both locally and globally, and I think that turned out to be correct. And then at some point in time, we started the easing cycle. And throughout this process of easing, we've seen that inflation has converged. We have some of the problems that are common to advanced economies and other Latin American countries, which is labor markets very strong. So there were 2 points of attention. One was labor market being that strong, would that at some point in time mean inflation in the service side? And even though we haven't seen that yet, what we try to do is to try to estimate what would be the components of labor in every service so that we can anticipate if that were to happen. We haven't seen it, but we think it's, there is somewhat of a correlation when you look at the margin. And so most recently we decided to pause. That had to do not only with the current numbers and with this suspicion that we had service inflation that could peak at some point in time, and also because food prices were going back up a little bit, and I also think that's not only happening in Brazil, it's going to happen in some other places too. But also has to do with a lot of noises that we had. So we decided to interrupt the cycle. More recently, we've had a sell-off in some of the emerging market countries. Brazil was more affected. But I think this has to do much more with noises that were created than the fundamentals. And the noises are related to 2 channels. One is the expectation on the path of fiscal policy, and the other one is expectation on the future of monetary policy. So when you had these 2 at the same time, I think it created uncertainty enough that for us, we needed to interrupt and see how we can fix that channel and how we can communicate better so that we can eliminate those noises. Because there is a big disconnection with the current data both fiscal and inflation data and the expectation. So what happened in Brazil is the expectation started to the anchor, even though the current data is coming as expected.
Right. So you're talking about the fall in the stock market and the real recently when you talk about the markets.
But for us, what matters is how this gets into our reaction function. So I'm talking about expected inflation, the long end of interest rate curve. So we had somewhat of a steepening of the interest rate curve. We had a devaluation of the currency. But for us, what matters is the expected inflation, both implied inflation from the markets and expected inflation from the surveys. Those have gone up.
Yeah, I mean, President Lagarde, you have described the path to 2% as bumpy. We got an inflation report in the Eurozone this morning, 2.5%, not too bad, but core was high and services are still above 4%. So what is keeping prices so sticky?
Well, first of all, we had, as you said, a number that was lower than last month. So we said it was bumpy, and it's proving heading in the right direction for the indicator that we use, which is HICP, to measure inflation and to set our target. So that's good, but we still believe that it's likely to be a bumpy road until the end of 2024. But we still have target at the end, in the second half of 2025, on the basis of our projections, and the baseline is unequivocal on that front. You are correct that services hasn't budged. So services is at 4.1, if I remember from the numbers that we got this morning. And obviously we are very attentive to the components and what is behind services. And the real issue is to understand whether those are, this is caused by sort of permanent changes, or whether it is also a factor of the lag effects of other components which are finding their way more slowly and gradually into services. And the jury is out as to exactly what it is. The truth of the matter is that we do have a service number that has gone slightly up in the recent months, and which is now staying at this 4.1 percentage points. Now, obviously, we don't need to have services at 2% because manufacturing goods are below 2%, and at the end of the day, it's going to be a balance between goods and services, and it depends on the weight of those within the index. But we have to look really what is behind it, and what's behind it is a lot of wages. Services has a very high component of labor. Wages also suffer from the lag impact of the labor system that we have in Europe, where clearly bargaining agreements are negotiated not only on an annual basis in some countries, but sometimes on a triennial basis in other countries. So you have this catch-up effect. You know, for those people whose renegotiation took place early this year, they had not had a negotiation of wages in the last 3 years. In the meantime, of course, inflation went up and their real wages went down. So there is an element of catch-up. So we need to really unpack all that to get to the root causes of inflation behind services. So we'll continue to look at that. We need data. It applies to wages. It applies to profits, because we are seeing profit gradually declining compared to the height where they weren't at the end of 22. But we need to see those profits absorbing the wage cost increases to make sure that the second round effect is out of the window, and services are also going to be on a declining path as well. But services is the difficult one.
I was just going to pose that Taylor Swift is touring Europe this summer, and there tends to be an inflationary effect in services. Am I right, Chair Powell? We saw it last year, didn't we?
It's not just Taylor Swift, you know, others have come as well. Larry Spring, yeah.
I don't know. I saw her at Wembley, and there was a lot of spending going on. No, but how do you look at the services, the stickiness of the services inflation, and how tied it is to wages, which have been rising?
You know, famously, services inflation is stickier, and famously it's tied to wages. I would say, so look at the U.S. labor market. We've seen a pretty substantial move toward better balance than we had a couple of years ago when labor was in, you know, extreme shortage. So what you see now is an unemployment rate that's moving back up toward a more sustainable level. You see wage increases moving back down toward a sustainable level of wage increases, inflation, and productivity. You see, you know, vacancies to unemployment ratio coming back to where it was pre-pandemic, and so many other measures I could mention. So that's what we're seeing. And so the labor market, wage increases are still a bit above where they would wind up in equilibrium, but nonetheless, you can see the labor market is you know, cooling off, appropriately so, and we're watching it very carefully. But it doesn't look like it doesn't look like it's heating up or presenting a big problem for inflation going forward. Indeed, it looks like it's doing just what you would want it to do, which is to cool off over time, not quickly, not suddenly, not steeply. It's kind of what we've been hoping to see and have been seeing. So, and you know, services generally they're such a mixed bag, particularly non-housing services are a mixed bag. Some of what you're seeing is catch-up inflation from inflationary pressures that happened earlier. You know, that's true with insurance. It's also true with housing services inflation, where you've got some pent-up rent increases that have to work their way off. It turns out it takes more than 1 year for that to happen. It takes several years. So we see all that in train, and you know, we don't see ourselves getting back to 2% inflation this year or next year, or maybe late next year, but in the year after. The main thing is we're making real progress.
Can you keep cutting President Lagarde if he keeps holding? Does it make it harder?
Well, look, you know, I'm going to give you the conventional response because that's the conventional question you ask me. We do take into account the spillover impact of whatever is decided by other esteemed colleagues. And obviously, my esteemed friend, Chair Powell, is one of those. So we take that into account, but we also determine, you know, our monetary policy on the basis of what we see in our economy. And we look at the data that we get, the impact that multiple factors have on our economies and its numbers.
Does it matter for you, President Campos, what the Fed does next?
Well, I think it matters to an extent, but I think there is one point that is worth mentioning, which is more recently we've seen a sell-off in some of the EM, and especially the EM that had more. There were like more the best cases for investment. And you see that this is being explained with local news. But when you have a lot of sell-offs in different markets and they're all explained by local news, you have to ask yourself if there is a more fundamental factor driving that. And I think there might be. It's difficult to make the case right now, but definitely what we see now is there is more risk premium in a lot of the emerging market countries. And it was very synchronized with the long end of the US curve, and that correlation broke. So we've seen the last couple of weeks that even though the 10-year yield is more or less stable, even actually going a little bit lower, we saw a bit of a sell-off in emerging market countries. And I think that has to do with the fact that as you go for longer with higher rates and much higher debt, you start extracting liquidity from the market, and eventually you are repricing that liquidity. It could just be a temporary adjustment in EM, or it could be the beginning of a more profound movement. We need to wait and see. But I think the correlation between the U.S. Treasury and some of the EM has been broken in the last couple of weeks. And I think we should pay attention to that.
What about the fundamentals in emerging markets? Because the economies seem to do better during this hiking cycle than they have previously. Why do you think that is, and does it continue?
I think most EMs did a better job in terms of, or at least an equal job in terms of anticipating the process and starting the hiking process. Also in the fiscal part, on average, emerging market countries spent more or less 10% of GDP facing the pandemic. Advanced economies spend a little bit more than 20. So I think there is also this thing which didn't happen in the past, which is by and large, emerging markets were able to deal with the pandemic spending less. And actually, when you look at the fiscal post-pandemic, Emerging market continues. It's not the case of every country, but continues to do a little bit better. So I think that also change the dynamics. And one of the things, I think, the independence of the central bank and the maturity that a lot of the central banks have gained in emerging market proved to be very useful during this process of the pandemic.
I mean, all of your economies did better than expected with the interest rate hikes. Wouldn't you say, Chair Powell?
Yes, I think particularly, I mean, many forecasters had a recession in 2023, which not only turned out to be wrong. In the case of the U.S., we had well in excess of 3% growth. So,
but you still see policy as restrictive?
Yes, we do.
How restrictive?
Well, so that's kind of an empirical question. So I guess I would say, if you look at, we do think policy is restrictive, and we think that's appropriate. I think if you look at the labor market in particular, you're seeing demand for labor gradually come down in the form of job openings, and now a slight softening in unemployment in the form of wages. You see demand coming down, not just the supply that we're getting, but also demand coming down. You also see the effects of high interest rates in the housing market and in some other interest rate sensitive things. So you see that, and I think, I do think that restrictive policy is working hand in hand with this broad supply side recovery we've had, where we've seen the unwinding of the shortages and bottlenecks from the pandemic. We've also seen a recovery in labor force participation among prime age individuals in the U.S., and then some immigration, which has also been a positive supply shock. So we've seen all those things work together to give us, really significant declines in inflation. At the same time, we've got a strong labor market and growth. This was it's a great outcome for the people that we serve, and it's one that we want to do everything we can to foster.
So why not just cut rates to protect it?
It's what I said earlier.
Is it a bigger risk? I'll rephrase. Is it a bigger risk that you cut prematurely and inflation stays sticky, or that you wait too long and the economy loses more momentum?
That is the question, and our answer to the question is we serve a dual mandate, right? And these two things are embodied in that mandate. The risk on the inflation side is that you move too quickly, inflation comes back, and we didn't really solve the problem, and then we have to go back in, and that would be very disruptive to the economy. So the other risk is that we wait too long. We understand that, and the labor market softens too much. Perhaps we lose the expansion. So needless to say, we don't want to do that either. So, but at the same time, so we've got to balance those two. And again, given the strength we see in the U.S. economy, we can approach that question carefully. But as I said earlier, though, you see, a year or so ago, we were talking about inflation, and our framework called for us to focus on the variable, the mandate that is further from its goal. That's not. They've come back much closer into balance, and a good way to see it is the beverage curve analysis that everybody talks about and looks at. We've come straight down the beverage curve, but you're really getting to that place relative to job openings and hiring rates, where traditionally the beverage curve is flattened out, which would mean higher unemployment as a result of further declines in job openings. So you can't know that with precision, but it's very much understood by us that we have two-sided risks and we have to manage them.
What about the recovery in the Eurozone, President Lagarde? It's also been pretty resilient, especially on the unemployment front. How confident do you feel in sticking this soft landing?
Well, we reached a level of confidence back in June when we decided to actually cut rates by 25 basis points. But as I said in the opening remarks, it's not something that is taken for granted, that is a given, and we're going to re-examine each and every step of the way whether that confidence is actually continuously reinforced in order to continue on that path. And the remarks by Chair Powell made me really reinforce my points about data, because we are navigating in this universe of one risk versus the other, but where data is so important. And data is so important because we proceed always with the burden of the lag of time, whether it's the impact of our policy decisions, whether it's the impact of wages, whether it's the sort of on-time data or not, all of that has to be taken into account and analyzed in details so that we can feel really confident that we can go forward.
At the same time, there are also political risks. Certainly they're front and center. It was nice of all the authorities to make elections all happen this week, certainly in France and in England. President Lagarde, is there anything the ECB can do to shield the rest of the Eurozone from feeling any negative impact from a divided government in France or from whatever the result is of the French election in a negative way?
I thank you so much for your question.
It can't be a surprise.
Because I'm not going to comment on the political situation of any of the member states, particularly those that are facing elections at the moment. But, you know, obviously, the European Central Bank has to do what it has to do. Our mandate is price stability. Price stability is obviously relying on financial stability, and we are attentive to that because this is part of our job, and we will continue to do so.
Does the rise in French bond yields look worrisome at all?
No, these are the things that we monitor. This is part of the job. It's you know, it's not particularly at this point in time. We do that all the time, and we are very attentive.
You have fought hard for the central bank's independence in Brazil, and yet now you are the subject of many attacks from President Lula, and so I'm wondering how you're dealing with that.
Attacks from me?
No, no. No, President Campos. Attacks from President Lula. I think he called you an adversary and an enemy.
Yes, well, I think as a central bank, we have to get away from the political arena and try to go on with the technical job. And I think what we did, I think, is a living proof that everything that was done was very technical. So during the elections in which Lula was elected, the incumbent president, in his last year of mandate, we increased rates in a cycle that went from 2% to 13.75%. That's the biggest increase in rates in an election year in the history of any emerging markets. So if that is not a proof that you are independent and you acted autonomously, it's difficult to find another example like that. So I think all this narrative that the central bank has been political, I think we have to get away from that and explain what we're doing. And I think what we're doing has been very technical. The last decision was unanimous, and we now have 4 members in the board that were chosen by the current president. And I think what we need to separate it was what is the political narrative and what is the technical job that we need to do. And I think history will tell and time will tell.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. Coming up, we're going to check in on the update on Hurricane Beryl. It is ripping through the Caribbean as we speak. We'll check in with Rob Caroline. He's a Bloomberg meteorologist. Get the latest there. Ira Jersey's going to join us here and give us his thoughts on this Federal Reserve. We got a lot of economic data coming out this week, including Jobs Day on Friday. So we'll check in with Ira, see where he thinks this Fed is going. Ben Glicklich, he's the CEO of Element Solutions. We're going to talk about technology, semiconductors. It's a chemical company, but their customers are really some of those big semi-fab manufacturers. So we're tying that tech angle to the specialty chemical business. He's going to be in our studio, so we'll talk all things tech and chemicals. But first, let's kick this hour off with Lisa Mateo, who's got a Bloomberg business flash for us. Lisa.
You got it. Market Drivers brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low transparent commissions. Learn more at ibkr.com/bonds. All right, we have more economic data coming out this morning. JOLTS job openings for May coming a little bit hotter than expected. The survey was for 7.95 million. The actual came in at 8.14 million. Now, the prior was 8.05 million, but that was revised down to 7.92 million. So you see the difference there. This, of course, coming ahead of Friday's jobs report. Let's say the reaction right now, not much going on. We have the NASDAQ, little change, down about 3 points at 17,875. We have the Dow, little change, down 6 points at 39,163. The S&P 500, little change, down about 2 points at 5,472. We'll check commodities right now. We have spot gold, that's higher at 2,332 an ounce. We have Brent crude, $87 a barrel. WTI crude, $83 a barrel. And then a quick check of currencies. The dollar weaker, Japanese yen weaker, euro weaker, British pound stronger. The yen we have at 161.50 against the dollar. Now, shares of Tesla, they are rallying after it delivered its deliveries beat estimates. Shares of Tesla now up 7%. That is your Bloomberg Business Flash. Paul and Alex.
Thank you so much, Lisa Mateo. Alex Steele alongside Paul Sweeney. Happy Tuesday. A little more on the JOLTS numbers here. Apparently, there's 1.2 available jobs for each unemployed job seeker. That feels like almost relatively in balance.
Yeah, exactly.
And apparently, the quits rate went down to about 3.4 million. That's relatively unchanged from the previous month, but a year ago, that was 4 million. So if you feel better, you quit. So if you're not feeling better, maybe you don't quit. So it just all points to that cooling, slowing labor market, but nothing maybe disastrous yet.
Yeah, that's what I kind of take away from it. Again, we'll get the change in non-farm payrolls on Friday, which I will be here for. I'm not sure I can.
I'll tune in.
You'll tune in, yeah, exactly. But we started the day, I started my day so long ago, and the consensus was for 200,000 change in non-farm payrolls. Now, at 10 a.m., it's 195,000.
What?
It changed in just 3
How
hours.
long have you been anchoring radio today?
I've been anchoring a long time, it seems like. Exactly.
25 hours later.
5,000 jobs gone, boom. So there we go.
All right, so in the markets, we're still on a headline level and nothing. Individually, still very interesting. Market Drivers is brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low, transparent commissions. Learn more at ibkr.com/bonds. Let's get right to more movers. Maybe they're not bonds, but let's get to it. Abigail Doolittle is joining us. You're looking at NVIDIA. Yesterday was a weird day for NVIDIA, despite the fact like Microsoft hit another record high.
NVIDIA right now is deeply in a correction, and yesterday was interesting because it started off lower, as it is today, down 1.7%, and then it finished a little bit higher. So that tells you the buyers are trying to get back in there. But right now, NVIDIA caught in what I would say is a pretty strong topping pattern. That's a fancy way of saying that people who bought well or low, let's just call it sub 100 on a split adjusted basis, are now wanting to take profits, but they don't want to take it in an obvious way so that it causes a panic, so they lose those profits. So they do it over time. So you have this back and forth over the last, let's call it a month, a little more than a month since they reported earnings. If below 118, NVIDIA will probably very quickly go back sub 100. What really stands out, though, is so we have NVIDIA down 1.4%, coming off of its lows. But what really stands out is Tesla now up 8% after gaining 6% yesterday, a 14% gain, back above its 200-day moving average. It is caught in a very bullish pattern, which suggests that it's going to go back toward its 2022 highs. So within big tech, net, the S&P 500 flat, it's almost like there's a funding rotation.
All right, but I got to point out, you created a monster here, RSI. Tesla RSI, it's up above the band. It's 79 and change here.
Agreed. So that is the 1 point cautionary point on that Tesla chart. There's an island reversal pattern, which is a very wonky pattern going on there. It's created two gaps. That's the one that tells you that the people who were shocked on the downside, they're now sort of shocked on the upside, and it's likely to create an equal and opposite reaction. I'm going to pull up that Tesla chart, though, super quickly live here, and let's take a look at the weekly RSI, because when you have a daily RSI, and I don't disagree, Paul, the one thing I would say about an RSI, and Ari Wald of Oppenheimer taught me this years ago, is you don't mind an RSI that's climbing. You mind an RSI that goes high and then reverses back down. So this RSI could go to 90 or 100. That would speak to that bullish momentum.
And before we let you go, Paramount?
Paramount, so it's interesting, still trying to find, exactly, this is the story that just won't give up. Still trying to find a buyer, and Barry Diller of IAC, apparently he's considering a bid for the company. Stay tuned. I mean, I just feel as though it's unclear what's going on here to me with this company and all these different bids and then leaving and what's going on.
Yeah, it's interesting. I think it's...
Stock is up, though.
Yeah, Barry Diller, obviously, he's 82 years old, a legend in that he is a true media mogul.
Yes.
You know, he's run everything from Paramount to he created a little thing called the Fox Television Network. So he's certainly a player, but he hasn't been a player in the media business for quite some time.
Quite some time.
Yeah,
but I think just his name and the interest, and because there's been such a problem getting something done here, maybe it is because of that past and his knowledge and connections that is causing the stock to go higher.
All right, very good. Abigail Doodle, thanks for joining us there. As always, getting a sense of what's happening in this market. You know, a big piece of news happening down to our friends down in the Caribbean is Hurricane Beryl. That has become, I guess most notably, the earliest Category 5 storm ever. So that gets your attention, and it kind of raises the question, where are we going to go for the rest of this season here? We're just at the very beginning of hurricane season. So let's check in with Bloomberg meteorologist Rob Carolyn. He joins us here. Rob, talk to us about Hurricane Beryl. What do we know about this hurricane? What has it done, and where is it going?
Well, what it's done is flatten the island of Grenada yesterday, and it is now headed on a course that's probably going to bring it very close to the island of Jamaica tomorrow afternoon. Right now, the system is due south to the eastern tip of the Dominican Republic. Tropical storm warnings are up for the southern Dominican Republic and the south side of Haiti. They'll be seeing 3 to 6 inches of rain today and some wind gusts over 50 miles an hour. The storm still, as of the 8 o'clock statement, winds of 165 miles an hour sustained. That means it's gusting to 185 miles an hour. The last Air Force reconnaissance mission I saw, the pressure had changed just very little in the last couple hours. It's come up a couple of millibars, which means it may be weakening slightly. It is forecast to weaken by the time it gets to Jamaica, but it's still probably going to be a Category 3 hurricane by the time it hits them. Right now, it's a Category 5 storm. It's not surprising considering how warm the waters in the central Atlantic and the Caribbean are. We've been talking about this all spring and early summer. The water temperatures are more suited for August and September rather than late June, early July, and that's why we've seen the system become a Category 5 hurricane.
What else is in the docket right now? Like, are there other storms brewing?
There aren't. We're keeping an eye on a tropical wave, which is near 45 west and about 16 north in the central Atlantic, but that one doesn't look very good. I think Beryl is going to be the big story. We had Tropical Storm Chris develop earlier this week just off the coast of Mexico and move inland. It didn't do a whole lot, but Beryl is probably going to be a hurricane now through the time it reaches the eastern side of the Yucatan Peninsula early in the morning on Friday. It will likely weaken going across the Yucatan Peninsula and then re-enter the southern Gulf of Mexico as a tropical storm for the weekend. Where it goes, northern Mexico or southern Texas, still up in the air. So this is going to be the big newsmaker in the weather department. It looks quiet after this for the next couple of weeks. There's a big cloud of Saharan dust following Beryl, and usually when you have those dry, dusty air masses over the Atlantic, we don't usually see a whole lot of tropical development.
Man, unbelievable. And what kind of damages are we talking about?
Well, I think from what I've seen so far, 80% of the buildings in Grenada have been damaged from Beryl's passage yesterday. It went through that area with winds of 150 miles an hour yesterday. The only good thing is it's moving at 22 miles an hour, so it's moving very quickly. But Jamaica's big problem, they're likely going to see winds sustained over 100 miles an hour. Jamaica's got some pretty significant mountains in the central part of the island, so there's going to be a lot of rainfall on their eastern and northern slopes, which is likely going to cause some landslides and some terrific flash flooding tomorrow. Parts of Jamaica are likely to see 6 to 12 inches of rain from this system as it goes by. So I think we're going to see catastrophic flooding in Jamaica and also a lot of wind damage, particularly over the southern half of the island.
All right, Rob, thanks so much for joining us with that update. Really appreciate it. Rob Carolyn, he's Bloomberg's meteorologist, talking about a Hurricane Beryl going through parts of the Caribbean here. Big economic week this week. Lots of economic data coming down the pike, including Jobs Day on Friday. We get the non-farm payroll, which is now looking for 195,000 jobs. So the Fed's going to have a lot to digest. Let's check in with Ira Jersey, Bloomberg Intelligence U.S. interest rate strategist. So, Ira, where do you think the Fed is as it sits here today digesting, you know, a JOLTS number, and they're going to get a lot more data coming this week? Where do you think the Fed is today, Ira?
Yeah, the Fed, I think, is looking for the opportunity to cut interest rates. I think they've made it pretty clear that they're done hiking, obviously. Jay Powell just this morning reiterated some words. He's at a symposium with two other central bank governors out in Europe. And he said, like, look, he doesn't want to cut too early, but he also doesn't want to cut too late, because if they cut too early, then they risk inflation reaccelerating, and if they cut too late, that could mean that they go into a recession. So I think they want to be cautious here. I'm still of the opinion that we're not going to have enough data that the Fed's going to be able to cut before the election. And I think there's other reasons in the back of people's minds. They'll never, ever admit it, but that they want to kind of, in order to remain independent, they want to stay out of the political arena. So, they know that things are slowing, but they're not slowing quickly enough for them to, I think, to cut in the very near term.
Yesterday, you had Morgan Stanley coming out with a note talking about steepener trade into a potential President Trump. Basically, you're going to see higher inflation, slower growth, therefore go bet on steepeners. What do you think about these calls we're starting to see?
Well, I think eventually the curve will be meaningfully steeper. I mean, the curve is still inverted depending on where you're looking. So if you look at the 2-year versus 10-year, that has moved 20-ish basis points from around negative 50 basis points to negative 30. I'm working on a note right now looking at market technicals, at technical analysis, and we're getting pretty close to an interesting technical resistance point. I think that steepeners make sense but the problem is, I think you're going to get stopped out once or twice if you get in now. We've already steepened a bit. We're probably going to pull back at least at some point, so there might be better entry levels for those types of trades. I think one of the big questions is, will we see if Donald Trump is elected, will we continue to see bear steepeners, right? So where 2-year yields basically have done nothing, all of this move has come from the 10-year yield moving higher, and that's on the expectation that we'll have higher deficits, that we might have higher inflation, that the Fed might not be as active. But I think at some point we're actually going to get the opposite. We're going to get bull steepeners, where you see 2-year yields go down to 4.25%, 4% from where they are today, whereas 10-year yields might not move quite as much, even if Donald Trump is elected. Because what's, I think, underappreciated by the market right now, they're all focused. A lot of people focus on the fiscal aspect of what Donald Trump might do, but he's also very likely to appoint a more dovish chair of the Fed and not reappoint Chair Powell. So I think once the market wakes up to that fact, I think you could wind up seeing some steepening, but the other way, right? So bull steepening as opposed to bear steepening.
I heard you just mention debt deficits, and we've heard that more and more over the last several weeks and months. But quite frankly, I've been hearing about the U.S. debt concerns my entire life. Does the market really care?
Well, they care a little bit, right? So the way that I look at it, Paul, is as the debt burden grows, and we're now, at or above, depending on how you count the deficit, above the debt is now bigger than GDP, is sell-offs will be more pronounced and rallies will be somewhat more limited, but we'll still rally, right? So if the inflation is lower, the economy is slowing, and the Federal Reserve is cutting interest rates, we will see Treasury yields lower than they are, at the start of that environment, right? So if we do have, in fact, a recession in 2025 or an inflation coming down and the Fed cutting 150 basis points, then interest rates are going to be lower, full stop. I think the reason why the debt burden isn't as big of a deal in countries like the U.S. or indeed Japan, if you just look at Japan and how much debt that they have, their debt burden is way higher than ours in terms of the size of their economy, is two things. One is that there's always a backstop buyer, right? So the central banks can buy the debt if they really need to, if there's any kind of liquidity problems. There's other